JE, paragraph 10 of the Uganda Public Service Standing Orders 2021, which is ideally to enable public officers to prepare and plan early for retirement and to assist retiring officers to prepare for a return to life outside the public service with alternative life skills, confidence, and without the fear of the unknown. Members are just to be reminded that retirement planning is for every single public officer. Many times we think it is for those who are about to retire. But as I told you, our aim is twofold. One is to prepare, and preparation starts from day one. When you join service is when you must start preparing for exit, because it's inevitable, it's going to come. And we have got a lot of testimonies from many people who are not ready for retirement because they never prepared. So we think that this initiative will enable everyone in public service to retire, to prepare, even if you have 40 years now. If you realize that you have one day. So it's very imperative that you prepare, and preparation is basically about how you plan to cross the other side of the world when you no longer be in active service. So it is very imperative, it's very important, and we encourage each and every public officer to attend this. Last year, we organized a similar training. The target was those who are left with less than 5 years to retire, but we got very good feedback. Many people actually joined the training with more than 5 years to retire. And as I've said, we realize that this training is relevant for each and every public officer because the time may seem a little too long, but it's definitely going to come. So it's very imperative that we all prepare. So yesterday we took you through the demystifying retirement. What is retirement basically, and why we need to prepare for retirement. And I think we had a number of discussions on that. Then we also had a discussion on the Public Service Pension Fund Act 2025. As I did explain yesterday, the Public Service Pension Scheme is being reformed. And this reform is because of the challenges being faced with the current scheme, which is non-contributory. And the Act is going to transform or reform the public service pension scheme into a contributory scheme where public officers will make a contribution, which will be managed by the fund, and this will make the access to their terminal benefits when due to be very seamless. And we hope that this will go a long way in ensuring that our senior citizens can enjoy their retirement. So those were the topics we handled yesterday. Today we have a number of topics. Again, we're going to look at how to the suitable investment options for public officers. This came a lot in the question section. People asking how can it be the public officer invest? How can they save? How can they start a business? Do they have money to start a business? The questions are several, and we've got someone from Bank of Uganda to come and talk to us about the suitable investment options that we can undertake as public officers. Take into account the fact that we're busy people, most of our time is at work, but what we can still do. So that will be done. And also we shall also look at the very complicated area of writing a will. We are going to have someone come from Office of Administrator General. This is something that many Ugandans actually don't do. Others feel that they are not comfortable doing that. And they think that when you write a will, it means you're about to die. But we are saying that that is not the case. So someone is going to take us so that when tomorrow you're not there, then your team, the people, your estate can be administered the way you wished. So these are some of the key things we thought you need to do. So just be in a way of recap of day one. I'm now going to ask us to start the recap. So what are the key take homes for you yesterday? What is that one thing you took home and you think is going to go along in your preparation for the eventual retirement? It could be a recap, it could be something you really learned and you're going to apply. Or alternatively, it could be a question, something you really need a little bit of clarity on. So I'm going to request that those who want to talk, you kindly put up your hands. And when I mention your name, you'll be able, you are requested that you talk. So if there's anyone who has anything to say, kindly raise up your hand and I'll be able to see that. And I'll allow you to talk. Okay. Any hands up, please? I just need the hands up so that we can talk and organize. When I mention your name, then you will make your point. James, you have something to say? Ekisa James? Odur Mike. Odur Mike Obong, please go ahead. Odur Mike, over to you.
Hello?
Yes, hello, we're listening. Kindly raise your question or your take home from yesterday.
Yeah. Thank you for all the facilitators and all the participants as well. Yesterday, I wanted to ask one question, but I was cut short by time. I'm now 56 years old. Hello?
Yes, I'm listening.
I'm now 56 years old, and I want to request for early retirement. But I'm having a challenge. I wanted to exit through political channel when people were asking for retirement on political grounds. But for me, I am having a challenge that my name has not yet entered the HCM. Now, I don't know how I can apply because I feel like I should now request for early retirement to allow me to do other things.
Thank you. The question has been noted.
I've worked for already 17 years now.
Okay, great. This is noted. Kindly will respond to that. Thank you,
sir.
Any other question? Any other comment? Any other take home from yesterday? We have SP Hudson, Joshua. Joshua, please, SP, Joshua. Can I have a question, please? Or comment?
Yesterday,
Joshua?
Yes, Joshua.
Yes, go ahead.
Yeah, what I learned yesterday and what I opted that people should know, it was about to.
Can you speak up on it? You're not very clear.
What I learned yesterday, and
yes,
what I really appreciated is about survivors' benefits.
Yes, please.
Because all in all, people have not been knowing what is meant by survivors' benefits, and now I got knowledge where I can at least go and disseminate that information to the people within my department and to the community, whereby when we lose our dear one, at least there is a survivors' benefit. Then also that we should not depend only police work, at least to do something was income generating activity. I'm so grateful. Thank you, sir.
Thank you very much, Safande. Thank you very, very much. We appreciate that. We have Wataka, sorry. Wataka Paul, your hand is up. Please, can we hear from you?
Thank you very much. I would want to get a clear calculation or computation of pension and gratuity. While you are saying the calculate, then 1/3 remains, you are paid 2/3. Just a clarification on that, sir.
Okay. Great. Thank you very much. We have HR KPM Eastern Region. KPM Eastern Region, can you kindly talk? Hello?
Can you hear me now? Good morning, sir.
Any policeman?
My question is, can you hear me?
HR is here. Eastern Region, can we have you, please?
Yes, can you hear me now? Because I wasn't.
Very loud and clear now.
Okay, my question is, what's the process of processing someone's gratuity or pension? And then also, how long does it take for someone to get, especially the one who is handling the estate, to get that pension or the gratuity?
Okay.
Thank you, sir.
Okay, thank you very much. This is noted. Pardon, can you talk? Pardon.
Yes. Can you hear me?
Yeah, loud and clear.
Yes, very quickly, less than a minute. Sir, thank you very much. Good morning, sir and colleagues. My name is Pardon Akugizwe from the Department of Public Health in Mountains the Moon University in Fort Portal. Yesterday, there were 3 sessions. Quickly, the first one, I just understood that retirement is here, and at one time we shall all retire, and we should look at it positively and prepare. That is what I got from that very first person who spoke to us. Then there came second person who told us about the exit options from public service. In fact, many people didn't know that you can actually live properly, apart from just absconding, being dismissed, and all those kind of things. Those are alternatives which are available so that you can enjoy retirement in the future. And honorable way of living the service, I appreciated it very, very much. And so then there came the youth who was the last, and took us through the different, the proposed scheme of retirement, having told us the burden the current scheme is likely to offer to the government. And so there's a proposed one for which, with the time it might be rolled out, almost similar to the way NSSF does their thing. And that was very, very appreciated. We are now well informed. We look forward to learning even more. And by the way, I appreciate you also answered my question very well. In case one was in local government and then transferred to this other agency where we pay NSSF, how will we handle our retirement issues? Well answered, and I understood it very well. I thank you so much. I just pray that you continue with this kind of service, sizing and empowering us, because information is power. Thank you. Over to you, and may God bless.
Thank you so much, Pardon, for that, and thanks for being there. Yesterday you were there present. We really appreciate that. And today you also started our day. We really appreciate. Allow me, members, to respond to some of these questions just before we take more, or potentially before we have our facilitator on. But let me start with the first question. Someone, one of our participants is 56 years old, wants to request for early retirement, but not on HCM. I don't know the vote you're from, but we expect that the policy now is for you to request for early retirement. You request through HCM. So we want to know that vote and you get help. Secondly, the deadline for requesting for early retirement is 30th of September every year. meaning that for this year, we have stopped receiving applications for early retirement. So any application for retirement will now be will start in next year, 1st of July, and the window is only 3 months. So by end of September, we also expect that we shall close the window. So I'm sure you'll be helped, and by then you'll be on HCM, because actually almost all the votes already in HCM. So we want to know the vote. You can send us a message in our chat box, and we'll take that up and discuss with the Department for Human Resource Management Systems. And then there's someone who made a mention of survivors benefit. They never knew about it, but they're so appreciative. Want to thank you. Yeah, this is the whole essence of this training, because we want to really close all the information gaps to provide as much information as possible to you, because we have a lot of benefits for survivors which are unclaimed, which sometimes we forward to Administrator General. So we request that when you lose a relative, then you're entitled to survivor's benefit. However, for one to get survivor's benefits, they must have a number of things. One of them, for example, they need to have letters of administration, because who is going to claim for that benefit? Not just anyone is going to come. And the fact that you're a son, a father to the deceased doesn't automatically guarantee you as the administrator of the estate. So there's a procedure for that, where the family will have to sit and nominate someone to manage the estate. And this will go up to Administrator General, where the person will be issued with a letter of administration. And that will be used as a basis. So kindly take note of that. And then another person was asking about formula for calculating pension. Yeah. How do you calculate your pension? Yeah, the formula in a nutshell is if pension is equal to salary, annual salary at retirement, your last salary, multiplied by your length of service in months, divide by 500. 500 is the denominator. So that's the formula we use. And if you can use this formula, you can be able to compute your own pension. And once you apply this formula, the salary, annual salary, you earn it by the time you retire, by the length of service in months, and you divide by 500, you'll be able to get your annual pension. And from the annual pension is normally good for 15 years. You will further multiply that by 15 to get your entire terminal benefits. And once you've got that, 1/3 of those benefits will be provided for you as what we call the computed pension gratuity. 1/3 will be given to you as a pension gratuity, and the remaining 2/3 will be given to you monthly as a reduced monthly pension for a period of 15 years. So the balance will be divided by the 15 years and further divided by 12 months, and that becomes your monthly pension, and that's what you'll be paid for 15 years. Or if you unfortunately die before the 15 years, your administrator, your next of kin, will be entitled to the balance of this money for the remaining 15 years. And then from there, we can stop the pension. However, if you're also alive, after 15 years of getting pension, if the pension is still alive, they will continue getting pension until they die. But the option of getting pension after 15 years is only for those pensioners who will be living. And once they die, then the pension is equally stopped. That is the process. What are the process of processing gratuity and pension? I think we went through this, but of course we may give a little bit of sharing of this, but basically we just want to, there are some it starts from documentation. One, we want to know what is the process, what kind of retirement have you got? That also matters on what you provide. For example, a person who has retired on early retirement will need a letter from Ministry of Public Service, the responsible permanent secretary, to grant you early retirement. However, a person who has retired mandatorily doesn't need to apply, because mandatory retirement is fixed. And then also you need to have all your appointment letters, your confirmation letter, and a couple of things. But I request you also to get in touch with your human resource departments or divisions, they have all the information that is needed, and they can give you a lot more information on this, and actually also additional provide you with the relevant forms that you may need. How long does it take to get your benefits, for instance, for the estate? Now, the length of the process has been shortened, and we try to expedite the process. One, the function of pension was decentralized to improve efficiency, and now when you retire, everything for your pension is within your vote. If you're in a district, there's no need to travel to Kampala. All the forms you need, you submit to your HRI. HRI will receive your forms and upload the necessary information on HCM or IPS for hostel and IPPS. Computations are done, and the captures will be done by the HRs, and even the assessments will be done by the head of HR at vote level. And even we have auditors in the districts, districts and also ministries, departments. They will be able to audit, and your accounting officers are the ones supposed to approve these payments. So meaning that everything is just within your vote, and we expect that the turnaround time for pension payment should not be more than 1 month if everything is done right. What we expect is that you, first of all, your HR need to get this information earlier, and everything is done early, so that if, for example, your November is your retirement month, then you get your last salary in November, and December you should be able to get your first pension and your gratuity. But this depends on how efficient our HRs will be, and and also the retiree, whether you have all the documents required and all this. So we encourage you to be in touch with your HR teams, ask them everything you need. And also for the estate, there are additional requirements that may be needed, because they need, one of the key things needed is the letter of administration. And this also depends on how fast the family does their Sometimes they sit in meetings, but they disagree, and there's no process to move on until the whole process is concluded. So that, I would say, is a little dependent on other factors beyond this, but otherwise, the system is seamless. The system can provide for very fast processing of the benefits of the estate. And then exit models. Actually, we did tell you about the various models of exiting service, and each model has its own benefits. How your benefits will be computed will depend. But again, I also want to advise that when you're retiring, as a retiring officer, if you're retiring through any means other than mandatory, kindly consult your human resource departments, divisions for advice. Because, for example, someone may qualify for early retirement and they apply for retirement on marriage grounds. And you may find that the benefits under retirement on marriage grounds may be much smaller than the early retirement, and yet they qualify. So our HR officers are in every single vote. Take use of these people. They are very knowledgeable. They're the custodians of past standing orders. So get to them, read through, and let them advise you and choose the best option that is available for you. Even some people opt for resigning, which doesn't attract any benefit, and yet by this time they already have something. Finally, there was a question about public service pension fund versus someone said it is just like NSSF. That is true. There's a lot in common, but again, there are still differences. There are significant differences. Probably at the tail end of this, I will have another opportunity to give a little more highlights on this. But as we promised that we shall start our presentation at exactly 9, and our facilitator is ready. So without wasting much time, I want to go usher in our next facilitator. And our facilitator is Madam Sylvia Chuko. Sylvia is from Bank of Uganda, but she's a certified financial literacy trainer. She's certified, she's a columnist in the newspaper. I know most of you have heard about her, most of you have read her articles in the newspapers, and she's one of the people who is most followed in Uganda as far as retirement planning is concerned. And our topic for today is retirement planning, how to manage the transition. And as I said, this is both relevant for those who are yet to retire and those who have also who have just joined service, still need this knowledge so that you start planning the transition right now. It's not a very simple transition if not planned for well. So it is very important that we all be attentive to this. So kindly listen, and for those who have questions, take note of your questions. And at the end of our presentation, we shall allow her to respond to listen to some of your concerns, questions, and respond to them as well. So at this point, allow me to welcome Madam Sylvia Juko. Madam Sylvia, are we there?
Good morning, yes.
Hello.
Can you hear me?
Good morning. Yeah, we can hear you loud and clear. Kindly, you're most welcome to start your presentation.
Thank you very much. Good morning, colleagues. My name is Sylvia Juko, as I've been introduced, and I would like to respect everybody in their individual capacities. Yes, indeed, I am Sylvia Juko, and I am really, really happy to be able to share with you. I am actually considering this a conversation because one of my passions is to normalize money conversation. So I am glad that the previous speaker has mentioned that yesterday you were taken extensively through retirement planning. So my work is going to be easy this morning because you are very well grounded about retirement planning. Now, first off, I need to give a disclaimer. I'm speaking to you in my individual capacity as a financial literacy trainer. You know the rules regarding public speaking and everything. So yes, I am employed at the Bank of Uganda, but for this presentation, I am speaking to you in my individual capacity. I am glad that some of you have been able to read my articles. I feel I've done this for the longest time, almost 2 decades of writing. And that's why I'm very, very passionate about money. Now, I would like you to think about a colleague who has recently retired. Do you think they planned about retirement? When do you think they did plan about retirement? Was it 10 years before they retired? Was it just 3 months to retirement? Or was it a year to retirement? Now, when you are in that situation, especially when now we are talking about retirement planning and managing the transition, it can be a little bit anxious if you're not prepared. But I am glad that you have this opportunity to train. I think I've been told a lot of you have 5 years or more to retirement. So do not take this for granted. The fact that you're talking retirement now, when it is still looming in the horizon, you are one of the lucky few. And to start off with my presentation, I would like you to think about this quote, favorite quote of mine, which is, the best time to think about your retirement is before the boss does. Think about it for a minute. The best time to think about your retirement is before the boss does. We are all hardworking. We take responsibility for our family and extended family. Maybe some of us are managing some enterprises, but realistically, you still have one boss who is government. Okay, we all have one boss who is our employer. Now, please make sure that your boss, your employer, does not facilitate your thinking about retirement. What do I mean? When you have to remind yourself that, oops, tomorrow I am leaving my active service. So all of us here, we are very, very lucky. Why? Because I was basing on the assumption that we have 5 years or 60 months to go. Of course, it could be more, it could be less, but the principle is you have 60 opportunities or more to save. You have 60 opportunities or more to invest. You have 60 opportunities or more to prepare. So the question I have for you today is, what is your situation today? The challenge between starting now versus waiting. Remember, every month you delay costs you compound growth and peace of mind. Why is that? I told you earlier when I was starting my discussion that think about that colleague of yours who retired. And I always encourage you, like I personally do, I have a lot of conversation with colleagues who have retired because they give you a very realistic environment or situation when it comes to retirement. So please find time and talk to your, whether it's a relative or a former workmate or anybody who has retired, and they probably have a similar similar job opportunity that you currently have. And get into that honest conversation. If they are honest with you, they will give you a rundown of the realistic environment that they are currently faced with. And then think about yourself and say, okay, Musoke retired last year. He had all these plans, all these dreams that probably their pension would tide them over. Or they thought that, you know, when you're working and you have trouble waking up in the morning, you think that, I can't wait for that retirement period because I'll have nobody. But have you ever thought about waking up early in the morning and you're used to a certain routine, and all of a sudden you have all the time and you're a bit panicky because you don't have any idea what you're going to do? So I want you to think about those scenarios in the future and how you plan your retirement to be. And I must tell you this, that retirement is an individual issue. It doesn't matter if you join the public service with, your best friend or the person you went to school with. When it comes to everybody leaving, everybody's individual circumstance will be at play. It doesn't matter whether you've worked together for the last 40 years or 30 or 20, irrespective of how much time you have worked. When it comes to retirement and the choices you're making today, it will affect you as an individual and your family and dependents. So just know that every month you delay has costs. Like they say, investment is an opportunity cost. If you choose X over Y, it means that you're foregoing whatever benefits would have come from Y. So every month you delay, if you choose not to do anything about your retirement, that transition or your evening years, it might cost you peace of mind. So that individual who retired last year, are they nervous? Are they comfortable? Do they have peace of mind? Or they are more stressed than they were when they were in active service? So I want you to consider that as we're going along with this discussion. Now, I don't know whether they gave you these statistics yesterday, but I always like using statistics because it gives you, they are facts, they give you a picture of how we are doing as Ugandans. I don't know whether you're familiar with the FinScope survey. The last report came out in 2023. I think Bank of Uganda contributes to gathering this information in this survey. And as far as I know, we are, I think, in the process of carrying out a new one. But this report of 2023 shows that more than 7 out of every 10 Ugandans have no concrete long-term financial plans. That is really, 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 really very, 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 very scary. 7 out of 10 Ugandans have no concrete long-term financial plans. I hope you can still hear me.
We can hear you.
Okay, that's great. Now, my question is, are you part of the 7 or are you part of the 3? With this training that your employer has prepared for you, you are moving very steadily towards the 3 out of Ugandans who have concrete long-term plans. Now, this survey goes further to tell us that 85% of Ugandans are not saving and investing for retirement. 5% of our population is aged 60 years plus. I want you to have these numbers in mind because, one, why do you need to know these numbers? You as an employee, as a worker, that means that your income that you're currently working for, the pie is going to get smaller. Why? Because your dependency burden, the people you look after are many. Okay, if the people you look after are many, then why should you can give up and say, well, I guess at some point things will take care of themselves. We'll just figure it out. No. Given the dependency burden, and I bet some of you, if you have a blessing of having your parents alive, if they did not adequately prepare for retirement, it means that you have the responsibility of looking after them. So do you see how your pie is growing smaller and smaller? Now, imagine by the time you retire, maybe in 5 years, in 10 years, depending on how long you have, do you think that pie will remain at the same share? No, it will grow smaller. Why? Because of these numbers. Because of these numbers, your dependency burden is growing. You are using more of your resources to take care of other people. So as you're planning for retirement, please have this in mind, that even you who is lucky to have this source of income, you are still taking care of lots of other people. Okay, so if you're taking care of lots of other people, that is the reason why you need to plan. That is the reason why you need to prepare, because you have to be in a position, you have to be grounded, you have to have a solid foundation. Like they always say that you cannot pour from an empty cup. You have to fill your cup to be able to pour. You have to plan for your retirement such that you're in a position, one, not only to look after yourself, but to continue supporting the people that you support. But even in this support, you have to support them with a plan. A lot of people have that I train come to me and say, you see, my relative is always asking for me for money, or I'm supposed to be contributing to a cause. Yes, we are in a society where we take care of each other, but you have to be very smart about taking care of other people, such that you don't leave, it doesn't leave you empty-handed. You have to take care of them in such a way that you still have your firm foundation from which you can share your resources. So I'm dwelling a lot on that because a lot of us underlook this scenario or this situation when we are planning for retirement. We have to plan within the reality of our situation. Before the numbers, I would like you to consider these essential questions. And before that, even, I would like you to respond or to ponder about this favorite quote of mine. A life which is empty of purpose will not suddenly become fulfilled on retirement. What do I mean? If you do not have a reason to wake you up in the morning as we head towards what I call the transition you know, because you're transiting from active service, familiar, you've done this for more than 30 years, you're transiting into the unfamiliar. Okay. And we also have to be cognizant of the fact that we plan and God laughs. But that doesn't mean that we shouldn't plan, because whatever happens to us during the transition to retirement, it is better when you're prepared. You know, whatever happens, any emergency or whatever situation happens to you, it always hits differently if you're prepared. So I would like you to ponder about this issue. As you calculate, actually, these 3 questions, when you answer them, they will help you be able to calculate what you require towards retirement and what you need to invest in during this transition period. Number 1, what do you want to be? A lot of you are known as commissioners, undersecretaries, principals, you know, all these fancy titles that we all have, and we are very proud. And even when we go out to our villages, you know, you're an inspector, you're depending on what you're doing, you're maybe a lecturer, we all love these fancy titles. But ladies and gentlemen, what is your identity beyond these titles? I always tease my colleagues here at work that we all, when we are in office, we are mandated to display our identity cards where they are visible. So I tell them that, okay, when you're getting out of that gate, your first instinct is to remove that ID. So what are you? I don't want you to tell me, oh, you see, you know, a lot of people who have left service, they are very, very proud to be announced. I am former so-and-so. I am former so-and-so. Yes, thank you very much. We respect you. Thank you very much for your service. But what are you beyond that former so-and-so? We are now talking about when you retire. You introduce yourself as, I am so-and-so. Personally, my introduction is Sylvia Juko, passionate about financial literacy. What my purpose is to normalize money conversations. That is how I want to be identified wherever I go. So please think about, what is your identity beyond work? What do you want to be when you've retired? You really, really need to think about this issue. Number 2, what do you want to do? Remember when I talked about that, what will be that one thing that makes you wake up early in the morning? Today, you wake up early in the morning because you're reporting to be that title we have talked about. Okay. 10 years, 15 years, I don't know, so many years to retire. That morning, when you said farewell, they threw for your party at work. The Monday morning, when you're used to waking up, you guys, I'm late, let's go. What are you going to do on that Monday morning? That's why you need to have activities. You need to start now. Personally, I teach about money. So even when I transition from my current job, that aspect of teaching about money, whether through talking to people or through writing, is something that is going to wake me up in the morning, ready to go, energetic and jeering to go. So please think about, what is that activity? Because don't take for granted that your job has been your identity for the last 30, 40, 50, I don't know how many years. All of a sudden, that identity is pulled from you and you're called former XYZ who worked with this ministry, former so-and-so. You introduce yourself to your peers, in your society. I am former so-and-so. But what is the current so-and-so? What activity are you going to do? What passion do you have? And what is your purpose? Remember that quote, a life which is empty of purpose will not suddenly become filled on retirement. The other question is, what do you want to have? This is very, very important because it determines what investment you're going to make, what choices you're going to make today that will lead you to where you want to go. What do you have right now? Assets, I hope they explained to you what assets are. These are the things that put money in your pocket. A car that you drive to work is not an asset because unless it is transporting stuff that is going to earn you an income. But if you're just driving from wherever to your work, that is not an asset. What, security do you have? Do you have insurance? Health. Remember, health contributes a little bit more when in those evening years. How have you catered for that health cost? Relationships. Who are you to those other people? Do you know who your neighbors are? What associations or membership do you belong to? We have people who are, have Rotary Club. Those ones are assured. Their relationships are secured. And then what is your legacy? Because at the end of the day, what do you want to be remembered for? That there lies this gentleman or this lady X, Y, and Z who did X, Y, Z. I have dwelt so much on these essential questions because they are going to determine how much money you need to have to be able to realize these three questions. And a lot of people have had that you are asking, what does the public service, what are the public service person invest in? What do they do? I always tell people, if you're still asking that question, that means you have a lot of homework to do. Because Sylvia Juko is not going to tell you, go and start farming. And you think that you're going to excel at that. I might have an idea, probably it has worked for me, but has it worked? But will it work for you? Do you have an idea what it takes to farm? Okay, if you're asking what are these investment options you must carry out, tell me, have you gone to visit any of such investment options that you're interested in? And this is not just a one-day visit, it is a visit over time to look at the trends. And this person that you're visiting, are they giving you the situation? There's some feedback from, okay. Yeah, so all these questions are very, very essential when we are talking about retirement planning. Now, I'm not sure whether they took you through calculating your retirement needs, but I think I want us to, if they did, then you're doing revision. There are 4 key aspects that I want us to look at today. When you're talking about retirement, you need to know your needs, because what else are you going to plan for if you don't know your needs? Now, how many of us know how much we have spent from Monday to today? How many of us have a record of what we have spent since the beginning of November? How many of us do know that? It is very, very, when you're doing this planning, it is good to plan with facts. You cannot plan in the abstract. You have to plan with facts. Why do you need this figure? Because you have to have an estimate. You have to have an estimate, How much do you spend in a typical month? We have all the lists of things we spend on accommodation, the usual things that we studied in science: shelter, accommodation, rather food and clothes. Those are the basic needs. But we also have other needs: utilities, fees, membership, medical costs, all those things. Do you have an idea how much you spend? Because I'm telling you, they say that if you do not measure, you cannot plan. If you do not know how much you spend, in the current period. How are you then going to plan 10 years ahead? You will be guessing. So if you do not have an estimate, if you do not have records of how much you spend, I don't even know how we are going to do this, because for you to be able to calculate how much with your retirement needs will add up, you need to know how much you spend on all these typical expenses that have highlighted, including social contributions, the facilitation you give to to your loved ones. All that has to be calculated. Okay. Now, when you total all those up, multiply them by 12. That is your current cost of living. Now, once you have that number, obviously, you need to adjust for retirement. You know that when you're retired, you probably won't need as much transport to commute. You won't need any work clothes. If you guys are lucky to be using uniforms, then probably, that is an expense that will be gone. Then you have to know that healthcare costs have to go up. You might want to travel. You might have hobbies. I want to do this. I want to spend time doing this. So I don't know what computation you've been given, but generally, a rough estimate is when you adjust for retirement, you plan for about 70 to 80% of your current costs. Okay. Now, another mistake that people make is that they calculate based on today's prices. But remember, inflation. Inflation is the rate at which prices rise over time. That is inflation. So whatever calculations you have, please factor in inflation. Today's 5 million will not be 5 million in years ahead. We are lucky that the Bank of Uganda, my employer, has kept inflation low and stable. But that doesn't mean that prices don't rise. When inflation is low and stable, it means that prices are rising in a stable way. It doesn't mean that there is no inflation. You cannot be in a situation where there is no inflation. What you spend on rice or sugar last year is not the same price you're spending this year. That is inflation. Okay. So when you get that calculation, you have to increase that figure that we have calculated by about 30 to 50% to account for the years of inflation within which you will retire. If, for example, there are 5 years, then you're accounting for 5 years of inflation. The other important step is to life expectancy. A lot of people don't realize that if you retire, I think the retirement age for public service is 60 now, for all of us, I think, if I'm not mistaken. Or at least at the Bank of Uganda, it's 60 years. Now, do you know that a lot of us live 20 to 30 years post-retirement? So, how are you supposed to live after retirement? If you retire at 60 or 65, you might have to live up to 80. That is 20 to 25 years that you need to fund. So have you planned, or in your plans, do you have those 20 years or 30 years? Because the thing is, you're not supposed to plan for just your life. You're also supposed to plan for those who depend on you. So we are talking 20 to 30 years post-retirement, because you need to consider those who are dependent on you. Okay, so when you get that, you calculate your annual expenses times the years, to retirement, and all factoring in all inflation. That is your number. That is your number. Now, I am glad I had people asking, how do you calculate pension? How do you calculate all these things? Now, my dear brothers and sisters, it's good to know that pension will be there, but I want to burst your bubble. Pension is not enough unless you want to dedicate your life to, or you want to drop your standard of living. then expect pension to tide you over during retirement. Pension, those who get NSSF is not enough. And also, one thing about pension, I've heard that there are some changes that they're going to do in the when it comes to pension. Pension is not in your control. You can wake up today and your former employer says, sorry, we are not able to remit your pension. What are you going to do? You have had, I'm certain that this is not news to you. You have seen news stories, or you've experienced parents or relatives who are telling you that it is 2 weeks since I was supposed to be paid pension, but it hasn't been remitted. Are you prepared for those circumstances? We should be happy that government, our employer, looks after us after we have actively contributed, worked hard for all these years. But just know that you are not in control. That's why when you plan, you put in place measures where you are in control. But you cannot plan from abstract. You have to know how much you're planning for. And when you know how much you're planning for, it will guide where you need to invest, how diversified you need to be, what will be your cash flow, all those things. So yes, it's good to have all these things with you, but is it enough? I want you to be brutally honest, and I call this assessing your current position. Please be brutally honest with yourself. When you calculate your cost of living 10 years, 15 years ahead, this pension that you're going to receive, that you are asking how it's calculated, will it be enough? What is the position of your other holdings? Do you have, when I say bank accounts, I'm assuming they are savings. What other investments do you have? What assets do you have? Another elephant in the room. What debts do you have to clear? In my employer here, by the time you retire, it is assumed that your debt will be at zero. I don't know how it's like with your situation, but my request is, whatever you do, please try and make sure that somehow you work on reducing that debt. Or if you have that debt, it shouldn't be, ideally, it shouldn't be commercial. You should be borrowing from maybe your circle, because the rates will be much lower. But imagine you are retiring at 60 or 65, and you have to pay debt from your pension, and that is all you are looking out for. Because obviously, if you have debts to clear, then your savings, I don't think you have really a lot of savings to look for. So the calculation is simple. What you need, let's have a ballpark figure, maybe 400 million for you to be able to retire comfortably. And this is a ballpark figure. It's not cast in stone. It is just an estimate. Some of you may need 1 billion. Some of you may need 200 million. This is an individual issue. Minus what you have in your assets. I'm not talking about these liabilities that you think are assets. In your assets, if you deduct what you need minus what you have, that is the gap. That is the gap that you need to fill. And I always tell you, mind the gap. How many months do you need to close this gap? Is it a small gap? Is it a big gap? If you don't have a gap, you still need to diversify and prepare non-financially. And I congratulate you if you don't have a gap. And I'm saying, beyond pension, what have you done? One of the things that I'm passionate about is saving. if you do not have the discipline of saving, you are not going to manage your retirement. Because this saving discipline, that mindset that you have to save, is what will run you through that period of retirement. If you do not have a savings culture, you will find it very, very difficult to manage your pension. You will find it very, very difficult to manage your investments. You will find it very, very... Why? Because the culture of saving is where you delay gratification. But if you think about, if you get money and the first thing you think, I'm paying the other person, I'm paying the other person, I'm buying this, I'm buying that, it means that even when you start earning from your business and you get cash, you're going to spend it because your system is not used to delayed gratification. For you think money equals spending. So it is very, very important when you're thinking about your transition, what savings do you have? And what are you doing with those savings? Because a lot of us don't have that discipline, but there are always measures for us to be able to save. I hope all of us are belonging to circles, and these circles must be registered and run professionally. Ladies and gentlemen, if you don't belong to a professionally run circle, I don't know how you're managing, because for us, circles, personally, my personal experience, before I even joined the bank, one of the things that made me improve in how I saved and how I managed money was joining the work circle. That means things like advance. I stopped taking advance. I had a commercial bank loan, which I made sure that with the savings I was doing in my circle, I was paying it off very fast. And that time we were unlucky. Whenever you paid up a loan before it was due, you paid more. But at least the central bank issued a circular whereby if an individual wants to clear a loan before it's due, before its repayment period, they are not charged, they are not penalized for wanting to clear their debt early. So for me, belonging to a circle made sure that the money, the savings that were going to a circle were a direct deduction from the payroll, which meant that before I even got money on my bank account, already there was a direct deduction. Now, if you don't have that kind of arrangement, the commercial banks do standing orders, and you have to be disciplined, because look, the decision you're making today is what? 19th of November, will impact you several years, and you have seen it through your career. The decisions, you remember those final decisions you made 5 years ago, they're impacting you today. You know one thing about money? When you make a mistake about money, you live with that mistake. If you went and borrowed, you did multiple borrowing because you're probably trying to, I don't know, whatever reasons you have. If you messed up with your borrowing, that means that you're paying right now. By the way, I need to find about my time. How am I doing with time? How am I doing with time? I hope, I don't know how many minutes I have to go. I wasn't really told how much time I had to present. I feel like I've talked for a long time. Okay, let's move on. Beyond pension, how are you diversifying today? Now, some of these, I always want to caution you that these examples are not cast in stone. I'm using them because they are familiar. You may not want to do the same. Of course, outside personal savings, these other ones that I'm talking about, for me to be able to tell you, do this, invest in this, invest in that, I need to know your personal situation, because I cannot tell you to go and do X, Y, Z when I don't know what level of debt you have. I don't know what responsibility you have. I don't know your financial background. So these that I'm putting, that you're seeing on the screen right now, are for purposes of illustrating the issue of diversifying your investment. However, the two that I can probably lean on, personal saving and treasury bonds. Now, treasury bonds, this is in case you're not aware what it is. This is basically you and me paying government to fund its expenditure. Remember, government has a budget. This budget is funded from, please mute your microphone.
And we are supposed to be aware of the that different departments are different.
Kindly, that feedback is interrupting. Thank you. Yeah, treasury bonds, as I was saying, is an instrument where you're able to lend government money to finance the different programs. Now, to be able to access treasury bonds, all of us hopefully have a bank account. You go to your bank and let them know that, look, I want to invest in a treasury bond, and this is how much money I need to invest. Please do what? Invest this on my behalf. You cannot invest with the central bank directly, no. You need to open what they call a central systems deposit account, where and your commercial bank is the one that helps you do that. So they open for you that account. Probably you have money on your account, which when you've instructed them, because you have to fill in forms. Banks don't just wake up and deduct your money. You have to fill in forms and instruct them to invest on your behalf, depending on how much money you want to invest in. The good thing is that with treasury bills and bonds, the Bank of Uganda has a calendar on the website. So with the treasury bills and bonds, we all know when these treasury bills and bonds will be sold. Like today, treasury bills and bonds, I think it's now at 9:46. Yeah, they're about to start. The commercial banks are supposed to start trading on your behalf, to buy these treasury bills and bonds on your behalf. Usually, small investors, whom we call retail investors, are given priority because Bank of Uganda is trying to encourage people to invest in treasury bills and bonds. So in most cases, when you put in a bid, you fill in those forms and you say, I want you to put my, the minimum investment is 100,000. But my advice would be you periodically invest, because you can't say I am investing 100,000 today and that's it. No, you will not really benefit from critical mass of investment. So probably you first start saving if you can, get a lump sum, and then instruct your bank to invest for you. So that is where the treasury bills and bonds come in. Now, in your portfolio, why you need to invest in treasury bills and bonds is such that if these other, each business has a risk. If you're investing maybe in commercial farming, or you're delivering a service, and somehow the economy is not performing well, then the treasury bills and bond investment is your anchor. Because whatever happens, it doesn't matter whether it's raining or shining, when it's time to pay your interest, if your interest is supposed to be paid after 9 months, or after 6 months, or after a year, you will not even have to call the bank. You'll just see your bank deposits grow because the central bank has paid your interest. Okay, so this is why they call them safe and secure investments. But they need to be part of the portfolio. Why? Because remember, when you're in retirement, you need something that will give you cash flow. So I always advise people that when you're investing in treasury bills and bonds, it is better to stagger them over time. Because when you do that, it means that over time, like if you've invested over a year and you've been putting your money in treasury bills and bonds, it means that 1 year from now, going forward, you will be receiving a monthly cash flow. And that is how you manage your retirement. Because remember, pension is going to come at the end of the month, but you have some needs that are falling in the middle of the month. Now, if your portfolio is only in a business where you're not sure whether you're going to get returns on that day, and then you fall sick, where are you going to get that cash flow that is going to treat that illness? So treasury bonds are very good because they augment the portfolio that you have. Another popular thing that has started now is unit trust. Now, before you invest in unit trust, these unit trusts are regulated by Capital Markets Authority. You need to go to the Capital Markets Authority website and see which are the unit trusts that they license. And then you also get more information about how they are performing. One thing I know about Ugandans is that they do not want to do this research or ask critical questions. If I am going to give you my money, you're a unit trust, I'm going to give you my money. First of all, I need to know, is my money safe? If anything happens to that, to my money, what happens? Who do I go to? Is there, recourse? If I am not happy with the person I'm investing with, can I go to, for example, Capital Markets Authority and complain? What are the risks? If this unit trust goes down, what happens to my money? So when you're investing in things like unit trust, you have to tick all the boxes. You have to make sure that you have all this information. Then, of course, there's the real estate. That's one I don't really need to dwell much on that. It is very straightforward. The circles, obviously, I told you before, I am an ardent promoter of having a lot of savings in your circle. My circle has helped me acquire land. My circle has helped me, get into several other investments. Then you have the small businesses, which are currently probably your side income and will become your main income later. One of the things I have to advise people is that personally, I know my weakness. When it comes to business acumen, there are certain things, even if I can advise you about them, personally, I cannot invest in them because they don't work for my needs. Okay. But I can tell you, go and start saving up in a circle, and maybe if that circle is helping you acquire assets, that is fine. That one I'm familiar with. But there are certain now these other investments, the popular ones like farming. I'll generally have a general idea about them, but I will not be as good as that farmer that you need to go and visit, because that farmer is on ground. They'll tell you that, what, these guys are saying that I hatched so many, and then within 3 months I was selling, but they don't give you the backstory. So when you are interested or invested in a certain business, please go and visit the farm. If you want to be a farmer, you have to routinely go and visit that farm, because a lot of circumstances are different. Money alone isn't enough, as I told you earlier. That whole discussion about purpose, money alone is not enough when it comes to transitioning or planning for retirement. I told you the purpose and identity. Who are you beyond your job title? Right now, you're very, very happy. You are dressed. By the way, a lot of the way you're being treated right now is because of the title, not because of you. So if they strip you of that title, the person who was respecting you today will be moving, will probably even bypass you and say, oh, by the way, I found so and so, and they were looking so miserable. They used to treat us miserably here. So just know that you are not your job title. So the issue is, what is your purpose and what is your identity? You have to prepare for that. We all know that there are so many people who retired with plenty of money but are miserable. Why? There are people who retired with not so much, but they are happy. Why? Because they thought about who they were beyond their job title. And I'll always ask you, what are you going to introduce yourself when you no longer work? I am the ex-commissioner, I'm the ex-principal. You need to think about what activities give you meaning. For example, what problems in your community could you help solve? Purpose doesn't retire. You may retire from being a commissioner, assistant commissioner, principal, inspector, lecturer. You may retire today, but your purpose doesn't retire. So you need to know what yours is beyond your job title, right? Yeah, so the other most important and critical thing that people underlook, health and wellness. You guys, money is useless. Of course, it can help you to pay for your bills. But imagine if you're too sick to enjoy it. That's why you need to get a full medical checkup. I hope it is mandatory for you guys to get checkups because that way you address any health issue where you still have, for example, if you still have some medical cover through work. I don't know how it is like, pardon me, but with or without medical cover, please start exercising. Yesterday and today, you probably spent a lot of time seated. This sedentary lifestyle is not, helping us. What are you doing about walking? You don't need to pay to go to a gym. Walking a few kilometers a day will help you. Working out in your compound, running up and down, that is enough. You don't need to, because you're going to say, oh, it's too expensive probably to go to the gym or what. Well, if you can't afford it, you can do it in your compound. You can do it at home. You can do it on of course, depending on what neighborhood you reside, sometimes it's very risky to walk because of the careless riders and all. But the thing is, you need to start exercising if you're not already. We are living, some of us have jobs. If you're not a field person, you're living a sedentary lifestyle. And we know from our relatives and friends and workmates that this has cost us our health. So you have to budget for healthcare costs in your plan, in your retirement plan. You have to budget for healthcare costs because obviously they will increase. We head to the issue of relationships. You guys remember COVID period? Do you remember the issue that people had? Do you know that there are certain couples that had not stayed together for that long and they were having difficulty? I have talked to a lot of retired people and they tell me that they struggle when both of them are at home because they never spend much time together. You're in, out, you see each other over a few days over the weekend. Maybe you go to church together. After church, you have lunch. Everybody's heading out to do something. Now here you are. You both, if you're lucky and you're both alive, do you know how to deal with each other when both of you are not working? And when you grow older, you also start getting grumpy. So those who still have your spouses, please start spending quality time with them. Rebuild relationships. Even outside work, rebuild relationships. Connect with your community. You guys have a lot of expertise. You can volunteer. You have a lot of information that a lot of people can benefit from. And a day in a month where you go and train people for free. This is the people who are happy, the retirees who are happy, are the ones who prepared holistically. They have some money, yes, but they also have a purpose. Their health is okay. Their relationships are thriving, and they're doing the activities they love. If you want to be a miserable retiree who maybe has the deep pocket, but you have neglected all these other things, then you're going to have trouble. So yeah, what will fill your days with meaning? I have done so much on that issue because a lot of people underlook it. It is very, very important to manage this transition. Common mistakes to avoid. I hope I'm about to wrap up. Common mistakes to avoid: procrastination. This whole thing of I'll start next year. Actually, I always get amused when I'm talking to the so-called Gen Zs, when I'm talking to them about retirement. Recently, I had a training for people who are just joined the bank, And I was talking to them about retirement, and they were looking at me strangely. I was like, yes, ladies and gentlemen, the best time to think about retirement is when you start earning a living. Don't let your boss think about retirement before you do, because they think they have a lot of time. I'll start planning retirement when I'm 30, when I'm 40. Before you know it, you're in your 50s and you start panicking, saying, oops, oh my God, I am running out of time. So please stop procrastinating. Every month you delay costs you 12 months of compounded growth. You do not have that time. Start this week, not tomorrow. Start today. Then the other issue I talked about, underestimating inflation and healthcare. You are going to, you always pray to God for a long life, but you're not planning for it. Please plan for that long life. Plan such that the resources you have even outlive you, because you don't want to be in a situation where you have a lot of dependents, and when the Lord calls you, then they start panicking and fundraising and so on. The other mistake is taking new debts. Ladies and gentlemen, if you have 2 years to retire, 3 years to retire, and you have a huge amount of debt because of multiple borrowing, you are going to suffer during retirement. I can assure you, nobody is going to, we shouldn't sugarcoat this issue. If you have a few years to retire and you're still wallowing in debt, you are going to have a very tough retirement. Retiring with loan payments is financial suicide. Imagine if you've been struggling paying that loan with your current salary. How about with your pension? The other issue which I'm passionate about is money silence. Please, ladies and gentlemen, start discussing money with your people. I know if you have not been, a lot of people are very secretive about money, and there is a reason why. Actually, one of the things that I've experienced when I write about financial disclosure in my column in the New Vision, that is when I get the most feedback, phone calls and emails saying, no, I cannot disclose what I earn to my spouse. That is entirely up to you. That is your call. But if you talked about this issue candidly and say, guys, we are about to retire. What life do we want to have? What is the current financial situation? This is good about managing expectations. If you're there keeping up appearances and your family thinks you have a lot of money when you don't, you're going to just die of pressure when you retire, because the reality will unfold and they're like, we thought mommy or daddy was loaded. Kumbe, it was all show, you know? So have conversations now. Even those people that you take care of, tell them that, guys, when I retire, you better start thinking about how, especially those who are in employable age. I'm not talking about aging parents, but those ones whom you're supporting and will eventually get an income. Tell them that, guys, you really need to start thinking about your plan, because when I head into retirement, the pie will have decreased. So I may not be in a position to support. So what is your plan? What are you doing now to earn an income such that by the time I transition through retirement, I don't have to take care of you? Have the conversations now. Please let these conversations be dinner table. The way you talk about football, the way you talk about other sport, go for what, please have these conversations about money. And for me, my mission is to normalize money conversations. We've talked about all this. You need to have a plan. 5 years, 10 years feel like a long or short time, depending on how you use it. But you have to, if you have 5, if you have 10, this is just a plan. You can adjust it to suit your situation. Foundation, yeah, we started about the calculations. You remember those calculations I talked about, how you need to know how much you're spending now, such that you can be able to determine how much you spend during retirement. Have all those calculations with you, know where the gap is. What you need to actually, those who are asking about pension calculations, you need to talk to your HR and ask them, please take me through. if I retire at this rank, how much pension am I going to get? A lot of people don't want to have that conversation because they think, now if I'm asking about retirement, what does this mean? No, go and have those conversations. Find out how much you're entitled to. That will help you ascertain what the gap is. What is your aspirational retirement fund or money? How much pension are you going to get? What is the gap? What are you going to do to fill that gap? Saving aggressively, investing, where are you going to invest? Investing for growth, investing for cash flow, investing for stability, investing, all those things will be determined by the information that you have. Don't plan through guesswork. Of course, year 2, because remember, it takes a time for something to become a habit. So probably by year 2, you're saving, you're investing, you're researching, you're working on your purpose. What are those things that, make you wake up in the morning? You're concretizing them. Don't wait for 60, 65 and say, me, I'm going to be a public speaker, and then you start investing money to learn about public speaking. If you want to talk for a living and you don't have any idea how to do that, you have to start now. Listen to people, attend all these courses, such that by the year 2, you are working on these things. Saving is a habit. That date, please, that salary advance, probably you've stopped taking salary advances. Those dates you're thinking about how to pay them off, how to earn more income to clear that debt, that is year 2. Year 3, it is to diversify, develop your purpose, Are you considering farming? Are you considering treasury bills and bonds? Are you considering unit trusts? Real estate, if you can afford it? Start seriously developing your retirement purpose. What are your hobbies? What activities are you going to do that are going to keep you busy and comfortable and happy? Start them now, not after retirement. Year 4, you're reviewing everything. Are you on track? I always advise that whenever you have a plan, you have to have reviews. I always write in my article, you review, first of all, you do quarterly reviews, and then an annual review, because when you're heading into the new year. So this retirement plan should be part of your entire financial plan that you have right now. And you keep reviewing and saying, oh, I still have this big gap. My debt is still big. Oh, I have not sorted out how I'm going to work with this cash flow, because your current cash flow is your salary. You have to have something that will replicate this cash flow that you have right now during retirement. You start thinking about those things and like, maybe I need to put more money in treasury bills and bonds. Maybe this farm is not working as well as I anticipated. Can I look at another area? Those are the things you need to keep doing. Then, of course, once you get to that time when, okay, now it's just a matter of months, then at least, you are mentally, emotionally, you're preparing for this transition. It's not just about money anymore, it's mindset. But you're also celebrating and saying, oh, 5 years ago, I started this journey. Now I'm feeling more confident. I can now, actually, I'm looking forward to the transition. I'm looking forward to that period of retirement. Obviously, there are so many resources. This workshop is one of those resources that are going to be very, very critical in this journey. And I really, really like to thank your employer for putting this together. But I am telling you, for me, for whatever I do, I always find an expert. I have written about money. I have talked to people about money for such a long time. But do you know that I still get financial advice? Because there are so many things I don't know. What you have learned today is not going to be sufficient to help you plan for your retirement. You need much more information because your goals evolve. Today, you may think that you need this amount of money for your retirement, and then next year, your ambitions are bigger. You're like, no, because I am looking at the threshold increasing, I need to add this to my portfolio. You go to a person who will give you personalized guidance for your situation. What I'm telling you now is general information. For you to be able to get a sense of the next steps forward, you need somebody to sit you down, look at your financial situation, look at your weaknesses, what is your knowledge gap, what is your skills gap, and then they'll be able to guide you on how to do your plan that suits your individual situation. Then, of course, Uganda Retirement Benefits Regulatory Authority has a lot of information. You know, it is very, very critical to be knowledgeable, because it will help you make very, very calculated decisions. There are online calculators that help you to do this investment, but the financial advisor will definitely help with some of these. Of course, workshops and seminars, you know, attend, please. By the way, learning financial knowledge is a lifelong endeavor. You don't read one book, you don't read one column, you don't attend one workshop on retirement planning and you think you have the turnkey solution to your financial planning needs. No, this learning is a journey. The way you've been learning as you work, as you grow your career, every other step of the way. Now we're in an era of AI. When you started your work, you had not even dreamt about AI. That means now, depending on what work you do, you have to learn what AI does. Did you think about that 5 years ago? No. The same with financial literacy. It evolves. There are so many situations that change. The way Uganda is today, 5 years ahead, it will be different. There will be new investment opportunities. There will be new products. So you can't say that the information you have today in this seminar is enough. No, it is just a base. It is just, you know, it is just tickling your mind to make you think more strategically about retirement planning. So yeah, you have to take action today. You have to take action today. So I don't know what has happened to the information, but we've basically covered a lot today. Some of it hopefully was uncomfortable, because when you are uncomfortable, it means you are ready to grow. Maybe some of it was eye-opening. Some of it was just a reminder. Some of it was frightening. That is good. Comfort doesn't lead to change. It is discomfort that leads you to change. So, whatever I've labored to do over the last 1 hour is nothing if you don't act on it. The only way you can benefit from what I've told you today is when you go back home today and put some of the things that you learned today and yesterday into action. So, not tomorrow, not next month, not next year. We are talking about today. If you do whatever you learned yesterday and today, and you have a plan and you put it in action, your actions, your future self will thank you. You have 5 years, you have 10 years, you have maybe less. That is a gift. That workmate of yours probably woke up 3 months before retirement in panic mode. You have more than 60 months to prepare, more than 18 months to prepare. I've given you, hopefully, I've given you a roadmap. There are certain pitfalls that I've shown you. The only thing that is left with you is the decision to act, and that is on you. So the question again, I go back, are you going to be part of this, the 7 out of 10 Ugandans who walk into retirement unprepared, or will you be in this other small group that have taken, or that take retirement planning seriously? The choice is yours. I hope you choose wisely, because your future depends on it. Please go and take action today. Thank you for listening to me.
Thank you very, very, very much, Sylvia for the very wonderful presentation. We really, really appreciate. We have a lot of comments in the inbox appreciating this. We are really, really very grateful. And I really hope participants have really listened to this and more importantly, are prepared to action this. Because as you clearly said, is that until we go and make our individual action plans, then we will not have achieved anything. And there are so many take homes for me, and that some of these things are things we have emphasized. We have done a lot of these trainings, but we're happy that it is coming from another person. You're a colonist, and I think a lot of people read your articles about financial literacy, about savings and all this and that. And we're happy today you've joined us and have listened to the best of the best. And this only qualifies what I've been telling our public officers on how to prepare. So we're really grateful. As I said, the take homes are very many, but some of the things you just emphasize, and these are things we talked about. Like we did emphasize yesterday in our presentations that pension is never enough. Pension can never be enough. And actually in the computation of pension, much as we don't have a maximum cap, there are very, very few people who get 100% of their salary replicated in the form of a pension. What that means is that we should all be ready for a pay cut when we go to pension, because the formulas will hardly provide you with a pension which is equivalent to your salary. Secondly, even when you go for the pension, when we are doing our works, there are a lot of other privileges we enjoy. Some people are entitled to fuel, they get fuel at work, some allowances when there was this and that, but this will all stop. So I think the message has been driven home. We have no option but to prepare for retirement. And that's all like the bit about what we need to get the gap of what we need, less what we have. And I think that's a personal reflection thing. We need to have a moment of soul searching, my dear participants. What do we envisage our pension, our retirement to be like? What do we think we will need? And what do we think we will have? We have given the formulas of pension. We expect that you should be able to calculate your pension as of now and also predict what your pension will be, because you know when you will leave, and you can predict one based on the current pay scales, what your pension will be. And that clearly gives you the income you will get from pension. So is it sufficient? Is there a gap? Sylvia has told us about that. And you also emphasize the need to belong to a circle. I think we cannot emphasize that enough. It is still surprising that we have some staff public officers who don't belong to a circle. And yet if you go to a market, if you go to those women selling charcoal, they still have a circle. They have a daily saving, they have a weekly saving, they have a monthly saving. But a whole public officer who is highly educated, respected, and all this doesn't belong to any circle. Members, time for soul searching. Don't put all eggs in one basket. I won't emphasize this anymore further. But more important, I want to talk about the wellness campaigns, and Sylvia talked about this. We have written to the service emphasizing this. All votes are supposed to have wellness campaigns and checkups. It's very surprising that we're losing a lot of our public officers to illnesses which are avoidable. And this is because people don't do any bit of exercise. And with this, many people want to think about a budget. If the budget is there, fine. But even without a budget, you can still have a wellness campaign. For example, I went to one of the districts. They didn't have a budget for this. But what the HRA will do is he will download some exercise to do from the internet, and the whole team gathers and they follow that. They couldn't afford an instructor, but they took advantage of technology and they got that. Finally, from me, I think an emphasis for me is the aspect of taking loans in retirement, paying your loans using pension. I think as a pension department, we have many of our votes who have realized are even giving retirement loans. Retirement loans meaning that you give a loan to a retiree who will use their pension as security, not really security, but the money is deducted from their pension. Of course, I've already said pension is not enough. You only make it worse by creating those deductions. But the law is very clear that the pension cannot be attached unless to pay a government debt or an order of court. So we don't expect our pensioners tomorrow to be taking loans and your small pension is further deducted. So it's all about planning. So thank you very, very much, Sylvia, for that. And I want to open up the discussion. I don't know how much time you have, but if you had some time, I will request that you listen to maybe a few questions participants may have, and then you probably respond to them before getting off. Otherwise, from us, the organizing secretariat, we are so grateful for the wealth of knowledge you've given us, but more importantly, for re-emphasizing some of the points I've been emphasizing for our previous trainings, including yesterday. So at this point, can I request for some questions? And when you're asking a question, kindly make it brief, because we want to have a number of people do that, and then we'll let our facilitator respond and leave at leisure. Over to you, participants. Do you have any questions? Can I get some hands up for questions? Yes, I see. ITEL A665L. Please, your question, please. And members, kindly, can we rename our things to our actual names and institutions so that we are able to take record of this? ITEL A665L. Sorry, I have to call your device because I don't see the name there. Can you please raise a question? Hello? Madam Nurieta, I see your hand is up. Can you come up with your question, please?
Thank you, Chair and the presenter. Yesterday I asked a question. I don't know if that was answered, but related to this and to yesterday's presentations, originally when they were coming up with the pension fund, they had mentioned that instead of yesterday mentioned, you talked about preserving the what? The pension for people who will be joining the new pension fund. Government will preserve what they've earned so far. But there was an idea of investing in annuities. The presenter today has mentioned that you can invest in securities, you can invest in government, treasury bonds. But what about when we talk about getting your money instead of government? If my choice is to get my money and invest it somewhere, is that possible? Will government allow that?
Thank you so much, Nuriat. That I'll respond to. Let's get more questions. I'll certainly respond to that. Thank you. Another question. Let me see who's there with a hand up. Gesa David and Okello Gabriel after. Can we listen to Gesa David? Mr. Gesa David, over to you. Can we start with the Okello Gabriel then?
Thank you, sir. I would like to thank the presenter for really a nice presentation. It's very encouraging. My question is on the unit trust and treasury bonds. So I wanted to know, how does the public officer venture into that business? Thank you.
All right, thank you. I think Sylvia will take note of that and respond. Yes, and then we have Techno C16 members. I still have to call your devices. I know it may not sound nice, but I have no option. Sorry, David. David? I guess David, you there?
Yes, moderator. Thank you so much. Yes. And thanks, Sylvia, for the wonderful presentation. My two queries are on one. You talked about saving. We are good at saving, though you commented that public servants don't like to save. However, sometimes there are these insurance companies that attach our salaries without coming to us and explaining this, how these things go about and how we benefit. I will give a scenario of Sanlam. In 2018, they came to Namaingo district and they enrolled all public servants to saving, a policy which they had not come on ground and explained to us. Now, I just used to see my salary being deducted until when I went and approached them. They told me, actually, even the beneficiary, they had put themselves. One of theirs was a beneficiary next to me. So what happens? I had to go and understand the policy. So I realized that it was just helping them, not me. So I had to end it. So then the other thing is about where Sylvia talks about not disclosing your earning or finances, maybe to your spouse or the person you're staying with. Sometimes it happens when you know maybe you want to make a investment decision and you realize that this spouse or the person you're with may not adopt it. And for you are seeing that it can help. So sometimes you do it and then later disclose that, at that point, this is what happened, but this is what came out. So it's all about, I think, knowing if the person can really buy your idea and also do it as a couple altogether. So it's about that. Then lastly, still on savings, I think we need these people to be regulated, especially insurance companies. They like attaching our salaries without coming. Because a policy, I must understand how it helps me. If I save, if it's a maybe health policy, if it is education, how does it help and how do I benefit? I thank you so much.
Thank you. That's noted. Can we have Lydia? Lydia, with your hand up, and now good leader.
Thank you so much, Livia, for the presentation. My name is Naguja Lydia. I work with Hoima District Local Government. I wanted you to help me, choose treasury bonds and then the unit trusts. Which one is better? Sometimes we even get scared that when maybe government changes, somehow money may, get lost from the bank. So which one is better, unit trust and treasury bonds? Thank you.
Thank you so much, Lydia, for your question. Godfrey.
Yes, moderator, thank you very much for giving me this opportunity to ask a few questions. My name is Godfrey. I'm in KCCA. My question is a general one to do with pensions for the people who are East African community workers who are expecting their pensions, and for a long time they have not been actually paid. What kind of comment do you have on that? And then on supplementing, or maybe trying to talk about the presentation by Sylvia, there's something to do with a situational approach to investments. It is something that needs to be emphasized, because when you look at given situations, you may find that different investments work well in different areas. So it's something that
the
needs
volume
to be...
has gone so low.
Yes, I'm saying the investments need to be catered for depending upon a given situation or area. Thank you very much, Mr. Moderator.
Thank you very much. We'll take one last one from Hilary Talemo, and then from there we'll allow our facilitator to respond. Hilary?
Thank you, moderator. Sorry, my question is related to yesterday's presentation.
Okay.
Me, I'm inquiring, we already have the National Social Security Fund. I'm wondering, why are we establishing a new pension fund for civil servants? Why not enter an understanding with NSSF, since it's a government entity and our pension is managed there? I mean, our savings are managed by the NSSF. That's all. Thank you.
All right, thank you very much. So at this point, let me allow our facilitator to come and respond to the questions. I'll respond later to the last two and the first one of preserving, but the rest I'll allow Sylvia to respond. Sylvia, over to you.
Thank you very much, MC Moses. And thank you very much for the feedback and the questions. They are very, very rich. Let me attempt to answer, but I have to let you know that I have to exit after, because I'm going for another meeting. So just indulge me there. Now the issue about unit trust and treasury bonds. Now, unit trusts, what I can say is that it's a collective investment where several people pull together their money to invest in a certain product. Now, we have several unit trusts in Uganda, and I don't want to do Kalango here, so you're going to go to the Capital Markets Authority website. I'll put the links in the chat for Capital Markets Authority and Bank of Uganda, where you can get information on treasury bills and bonds. But in short, Capital Markets Authority authorizes or regulates these unit trusts, and these unit trusts are mandated to approach individuals, telling them that they will invest their money collectively in a certain asset class. And these unit trusts actually usually invest in treasury bills and bonds, invest in maybe shares, both local and regional. And I think they also do fixed deposits. So it depends on an individual unit trust. And some of these, what you would call fund managers, are also insurance companies. But I want you to be very, very keen on what these unit trusts are and whether the product suits your needs. Don't invest in unit trust because Sylvia is investing in this unit trust. It has to cater for your need. That's why you have to do some research and say, okay, unit trust X maybe has a very good product for, let's say, if you want to set up an education fund for your dependents, then maybe you are going to do a unit trust. Or if you want to set up an emergency fund for your dependents. The good thing with the unit trust is that you can start, some of them even have those apps where you don't even need to walk anywhere. You download the app, fill in, I think, use your national ID. They'll take that information for know your customer purposes, and then you can send mobile money and start investing. But please go to the Capital Markets Authority website to make sure that the unit trust you're dealing with is regulated by Capital Markets Authority. I'll send you the link in the bio. Now, treasury bills and bonds. Now there's I think it was Lydia from Hoima who was trying to say, what do I choose between treasury bills and bonds? Which is better? And there's fear that if government changes, you lose money. Now, what I always advise people is that it's not practical to compare mangoes and oranges. Each investment option has advantages and disadvantages depending on your individual circumstances and your needs. Whenever you're going to invest, you ask yourself, am I investing for, capital gains? Am I investing for cash flow? Am I investing for preservation of cash? So all those things you ask yourself and know that, okay, because I need this money intact maybe in 6 months' time, then I can put it in a 6-month treasury bill, because after 6 months, I'll get this principal plus the interest. It is safe and secure. So choosing a treasury bill as opposed to going and trading in, I don't know, in any product would work for you because you surely need that money in the next 6 months. When you go and buy products or produce, maybe you want to deal in maize, you're not sure that at the end of that period, you'll recover your money. So for these asset classes that are called, I think they're in the fixed income category, unit trusts, treasury bills, and bonds, you are certain that you're going to get your principal and interest at the end of the period. You know for sure that if I put 1 million at the end of, let me say, we have 2 years, 3 years, 5 years, 10 years, 12, 15 years, and 25 year treasury bonds. You know that after this period, I am going to get my principal of 1 million plus the interest of probably 15% minus some withholding tax deduction. So for this kind of investment, you know for sure, but I wouldn't advise you to say, I prefer this as opposed to that. Each of these investments have different purposes they serve. But what I can say is that for unit trust and treasury bills and bonds, you are certain that the money you get there, you invest the principal, you'll get it plus interest. And with unit trust, these people have very good apps that you can even see your money grow. You can, they have what they call dashboards. When you put in maybe 1 million, at the end of 6 months or a year, you can be able to track and see how your money is growing depending on where they have invested it. Remember, unit trusts are also investing in treasury bills and bonds, but the advantage with them is that because it's a collective investment scheme, there is that power in numbers. For you going in as an individual, you're not going to get the same, the same weight as for them who are collecting a lot of money from different individuals and investing it in one go. So I would advise you to do both. If you're not sure what to go with, please do both. They are all safe and secure. For the treasury bills and bonds, Bank of Uganda's website has very, very clear information. It has what we call an auction calendar. Now, the auction calendar will tell you how much treasury bills and bonds are going to be sold up to the end of the financial year, which is June 2026. So it clearly indicates now, like today's auction, it's clearly indicated in the calendar that Bank of Uganda is going to auction, the trading is called, auction. Today, Bank of Uganda is going to auction treasury bills. So you know that on Wednesday, 19th of November, Bank of Uganda is going to auction a treasury bill. The treasury bonds are going to be auctioned, I think it should be, I'm not very certain, but before the end of this November. So usually what you do, you go to your commercial bank, and I have to advise you that you have to be very, very clear about what you want. Because if some of these commercial banks, probably they might have, the individual you're working with is not very familiar with this product. So if you go fumbling, they may dissuade you, or they may tell you, why don't you do this and this? You have to be very, very firm and know that me as Lydia, I want to invest in a 5-year treasury bond, which will be auctioned on, let's say, 26th of December. So when you're filling in that form, you fill in, they'll give you a form to fill in to open the Central System Depository account. That account is opened by all investors who want to invest in treasury bills and bonds. That account is held here at Bank of Uganda, but you as an individual cannot access that account. It is the commercial bank that you have to go through to be able to activate that account. So that's why you're going to fill in forms. If you don't have it already, if you're not already investing in treasury bills and bonds, you have to fill in that account from your commercial bank. They are basically trying to help you, because you can imagine if everybody was working here, it would be a little bit overwhelming. So they want you to use your commercial bank. You go in there and tell them, I want to invest in either a treasury bill or a treasury bond with this amount, but you have to make sure that you have that money on your account such that when the bank is deducting it from your account and remitting it to the central CDS account, Central Depository Systems account, there is something there. So that's what happens. You sign those papers and let them know that I want you to deduct maybe 1 million from my account to invest in this 5-year treasury bond, which is going to be auctioned on maybe 26th of November, or I think after November, the next auction will be in January for the treasury bonds. Now, the issue about change of regimes, change of governments, I want you to tell me if you've ever had anybody come up and say, guys, because we moved from one government to another, I lost my money. That has never happened. Irrespective of regime changes, the thing is government is government. The holders are the ones that change. Government stays. So irrespective of whether a regime changes or not, your money is safe. You will still get your treasury bond interest rate being remitted. Now for treasury bills, sorry, I'm going back and forth, but I just realized that I haven't distinguished between treasury bills and bonds. Treasury bills are shorter term instruments that go for 3 months, 6 months, and 1 year. Now the interest is determined on the auction day. Now, like people who invested in treasury bills did not know how much interest they are going to earn, because the interest is determined according to today's auction. The people who are investing large amounts of money are the ones who dictate and say, government, I am going to give you probably, I'm talking about now commercial banks, I'm going to give you 1 billion for maybe 1 year. I am giving you this interest. And then government will say, we'll get all the different interest offers, and then we'll say, no. I think this is either too much or too little. For this amount, we are going to pay you this interest after this period. So it is that interest now that is dictated to now for us, the small, what we call the retail investors. So for treasury bills, the auction the interest rate that you'll earn on that treasury bill is known after the auction, the Wednesday's auction. So the interest rate that will be paid, you'll know it tomorrow, because we publicize this information on our website and social media channel, and in the newspapers, that these were the results of the treasury bills auction, and this is how much was paid for the 3 months, 6 months, and 1 year. Now for the treasury bond, when I share that calendar, you'll be able to know that for a 5-year bond, for example, they are paying 15% interest. So you know that if I invest in this 5-year treasury bond, I'll be getting 15% interest annually. So that interest is already predetermined in a treasury bond. Treasury bonds are usually longer dated paper. You invest in 2 years, 3 years, 5 years, 10 years, 15 years, and 25 years. So you know that after 5 years, I'll get back my principal plus interest. Now, this interest is paid twice a year. So if you invested, let's say today in November, you count 6 months, the interest that was supposed to be remitted at the end of the year is divided into half and paid to you after 6 months, and then after the next 6 months. So that's why I was saying that when you're investing in a treasury bond, if you have the money and you want this cash flow to up or to up what your salary has been giving you, because when you have a salary, you have that monthly cash flow. But when you have a pension, which you do not know when it will come through, if you invest in a longer dated treasury bond consecutively, if you have them, I'm just saying if you have that money, if you have the money and you put in, some investment every other time, every month throughout the year, it means that when they start paying interest, that pattern will follow, that you'll be getting that interest every month because you have invested in the previous 1 year consecutively. So That's usually some retirees do that because they want some cash flow, some resemblance of cash flow every month to, you know, to imitate what the salary has been giving them. That is now with treasury bills. Let me just jot down here that I need to send the links in the chat. The issue of not disclosing your earnings. I'm telling you, this debate cannot end here. There are those who are pro and there are those who are anti. But like I told you, do what suits you. If you're comfortable having these discussions with your spouses, please go ahead. If you feel uncomfortable, you can continue with the status quo. The issue is, this does not stop you from planning. KCCA, that one, Moses will handle. This whole situational approach, I agree that different investment work well in different areas, and that's why I was telling you that each of us have a certain skill set, we have a certain knowledge, we have a certain business acumen, and we're in different situations, even if we work together as colleagues. So your choice of investment will rely mostly on those matters. It's not about, oh, Moses has invested in poultry and he has made a lot of money. I'm also going to go into poultry and I will make a lot of money. Moses' circumstances are very, very different from yours, you know. So yes, I agree. Situational approach to investment works. I think I have covered most of the stuff and I beg to submit.
Thank you so much once again, Sylvia, for the very wonderful and elaborate responses. I think we have really got a lot of value. Just before you go, I'm going to invite Mr. Adam Tusime, Assistant Commissioner, Human Resource Management in charge of wage bill, who has been at the center of this, coordinating this invitation, to come and give a vote of thanks. Adam?
Yes,
Adam,
Moses. Yes, I am.
Can we get a vote of thanks to our wonderful facilitator from you, and probably tell people a little bit who Sylvia is?
Well, thank you, Moses. Good morning, participants.
Good morning on their behalf. Their mics are muted.
Oh, how are you? Yeah, thank you, Moses, for giving me this opportunity to give thanks to our today's facilitator, Sylvia Juko. Before I move my vote of thanks, I would like us as participants to congratulate ourselves for having been given this opportunity to listen from Sylvia Juko. Members, why I'm saying we should congratulate ourselves is because Sylvia is not easily got, especially when it comes to these specialized trainings. To confirm, I would request your indulgence that I tell you who Sylvia is, and I'm sure you will agree with me that it has been a rare opportunity. Sylvia Juko is a communicator and a Bank of Uganda certified financial literacy master trainer. That one is highlighted red and in bold, with a career spanning over 2 decades. Currently, she works with Bank of Uganda as acting team leader internal communication, and prior to that, she was the media relations advisor. As a financial literacy master trainer, Sylvia has designed and implemented various, both in person or virtual, individual and group financial literacy training programs that have empowered clients in managing their personal finances. She was part of that team of Bank of Uganda financial training of trainers of financial modules and training guide, as well as the core messages for financial literacy classes. For the last 17 years, Sylvia has authored weekly column on personal financial management that is published every Thursday in the New Vision newspaper, which provides readers with the fundamentals of money management. Sylvia is a co-founder of Financial Diet Limited, an organization dedicated to empowering individuals and businesses with essential financial management knowledge and skills. As a communicator, Sylvia has well-developed skills in corporate communications, strategic media relations, stakeholder engagement, including writing and editing, as well as expertise curating messages for traditional and emerging media with a track record of excellency in Uganda's media space. On social part, Sylvia is a golfer and she plays at handicap 20. So members, I think you entirely agree with me that the person who has been talking to us is one of the most pressed people that would have handled the subject. Agreed?
Yes, agreed. Mics are muted, but I totally agree on behalf of the participants.
Sorry, okay. So for that matter, Sylvia, I take the noble honor. Thank you for having accepted to come and talk to us on the topic you handled. And we all picked a lot from it. And we promise that what you've taken us through, really, we are going to abide by us. Members, Sylvia, as you've heard, if you want more information, especially on money matters, expenditure, and savings, always buy the New Vision of Thursday. She has her article there, which are thrilling. Actually, I would like to confess that for the 3 years I've read, I'm an avid reader of her articles. I have drastically changed in financial management matters. Sylvia, I'm sure I'm not lying. Even Moses can testify to that. So we thank you and for having accepted to talk to us on a short notice. And we pray that the next time we invite you, please honor our invitation. Thank you, and thank you very much. Yeah. Moses.
Thank you very much for your kind introduction feedback.
Yes.
All right. So all the best, Sylvia, and we shall definitely get to you for any future engagements. Thank you very much. God bless. Members, thank you very much. That was it from Sylvia, and I encourage you to actively read her columns. It's really very educative. It's one of the things. I think I also probably get it on New Vision Online for those who may not want to buy the hard copy. I think it's also there available online. So kindly make sure you do that. All right, members.
Moses,
yes, please. Yes, please.
I've seen some members requesting for the presentation, her presentation. So we are going to share it with them.
Yeah, that's okay. All present will be shared. Yeah. Okay. Thank you very much. At this point, allow me to respond to some of the questions which came up, which are not necessarily in Sylvia's docket, but also came up. There was a question, first of all, Madam Nuriat asked about preserving previous pension. Yesterday, when I presented about the Public Service Pension Fund, I did say that you are not going to lose your previous service benefits. When we start the fund, your previous benefits will be computed and you'll be issued with a retirement bond, which will be actualized, which will be actualized or cashed by the fund when you do for retirement. And I think that was well received, but Madam Nuriat had asked, is there an option for us to give this money to people for them to invest their money themselves? And I will say no. 2 reasons. One is the whole essence of Social Security is people's inability to actually appropriately save these monies or invest these monies. I think even we have got statistics from NSSF that even when people are given their lump sum money, they still in 3 years, they don't have any money. So what does this mean? If we are to give these monies to all the beneficiaries and say, fine, this is your money for the past experience, service, what are the chances that they'll have this money by the time they retire? What are the chances that they're going to make wise decisions of investment that will stand the test of time? So for that reason, and for the purpose of Social Security, this money can only be actualized when you're retiring, and the investment is done by government. And for this case, all our funds and public service pension fund will be invested by the fund. And that's the same thing NSSF is also doing. People are contributing millions of monies every month to NSSF, but trust me, if they go to NSSF and see what they have, if they never made a contribution, if the money for contribution was given back to them, how many of them will have the amount of monies which are still there? So that's the question. Second, this money is not readily available by the time the fund is started. That's why they were giving a pension bond, a retirement bond. And this retirement bond will be cashed by the fund on your behalf at your retirement. So that's exactly the reason we give this. And as I clearly say that if you look at the presentation of Sylvia, you don't need all that money to invest. Of course, she gave the options of 1 million. Even I think when you look at treasury bonds and what they normally advertise, and it starts from 100,000. And what we're really, the message we're putting forward, members, is that you don't need to have all the money to start this. If you have 1 million somewhere, why don't you start the journey and start buying these bonds and then buying the treasury bills and all this and that? So that with time you keep seeing and you see your things grow. So my request is that this is an area for Social Security. No Social Security, you cannot be allowed to have your own Social Security in advance for the simple reason that it may not achieve the purpose for which it's intended. It's supposed to elevate old age poverty, and also to ensure that by the time you're retiring, maybe you have some money to start an investment or something, this and that. And then there was another question about NSSF and then public service pension fund, and someone was asking, why are we starting a fund when there's NSSF? Why don't we just join NSSF? Now, I want to first of all tell you that one is the public service pension scheme is older than NSSF. As I told you yesterday, the public service pension scheme started in 1946, and the NSSF started much, much later. So I just want to, we are simply changing the arrangement. We are simply reforming the fund from a non-contributory scheme to a contributory scheme. Now, what we're saying is that unlike before where members used not to contribute, government will meet the obligations 100%, which is becoming a challenge for government because government also has other pressing priorities and all this and that. The fund is being established so that monies can be deducted from employees' basic pays, and in addition, the employer makes a contribution which is independently managed, such that when you retire, the budget of Ministry of Finance, the budget presented, the consolidated fund doesn't become a factor to us. If government changes priority and say that the minister they want to focus on roads, that will not affect pension because pension fund will be managed independently under the fund. So the pension fund is the big difference between our fund, the public service pension fund, and NSSF is NSSF is a provident fund. A provident fund is a fund which gives all your money when you qualify. Now with NSSF, if you've been saving for 20, 30 years, when you clock the year, I think it is 55, I'm not sure. If you clock that year and you want to access your benefits, you can access the entire benefits. If your benefits are worth 500 million, they will give you all the 500 million at once. And that's what the Provident Fund does. But for us, our fund, Public Service Pension Fund, is a pension fund. Now for a pension fund, we don't give you all the money at once. That's why in the Act, we will only give you 1/3 of the money. Meaning that if your money at retirement is say 600 million, the entire package, we will give you 200 million, and the remaining 400 million be given to you in monthly installments for 15 years. And the understanding is that we still want to elevate the old age poverty. NSSF people will get their money, and some of them will mismanage. Of course, there are a few who will start successful businesses and grow it even further. But for a pension fund arrangement, we spread the payments over 15 years so that you continue getting these monies. So that's one big difference. Another difference is that NSSF is what we call NSSF, and another big difference between NSSF and our fund is that NSSF is what we call a defined contribution scheme, and the Public Service Pension Fund is a defined benefit scheme. What's the difference? A defined benefit scheme like the one we have is a formula-based fund whereby your monies you will get will be determined by a formula. Meaning that it is possible that at retirement, the monies you have saved, you may be given maybe more than what you actually saved, including the interest. Why? Because our pension will be determined by a formula. Unlike an NSSF, whereby the monies you get will be simply your own monies and the interest they will have accrued over the period, which is declared annually. And NSSF is not, for our fund is guaranteed by, is sponsored by government, guaranteed by government. If anything goes amiss, government will take up. NSSF is not guaranteed. It is guaranteed by members. Meaning that if NSSF make very huge bad investment decisions, and that means that the members will bond it. That's why if there are very many good decisions and the NSSF makes a lot of profits, the profit is for members in terms of dividends. But equally, the members bond may also need to bond a loss if huge losses are made. So that's the difference. I just want to bring the bit of difference between the two funds. And that is why we have, government has chosen to go for the Public Service Pension Fund. And our fund, as I said, for now is a direct benefit. But this is an act of parliament, and in future, some changes may be made if need be, depending on the prevailing circumstances. But for now, that is what I can say about the two funds, and I hope we now understand it. Then lastly, someone was asking pension for former workers of East African Community. Some have not accessed their benefits. What can they do? All I can say is government has continued to pay these benefits. All I can say is they need to come and claim their benefits. And when they come and claim, we need to ascertain that, first of all, they were rightful employees of East African Community. And second, we also want to prove that they were never paid, because a lot of the people have been paid and they will not be aware. And also some of them were paid. Now, under the law, sometimes we pay benefits to Administrator General, which is custodian to all those people we may not immediately track. Some people die, we don't know about them, but when their benefits are due and we can't track them, their benefits are sent to the Administrator General, who keeps the money. And some of them will now, when they come to us, we refer them to the Administrator General, and then a couple of them have really got their money. So I'm requesting us to be proactive, but we have the Ministry of East African Community Affairs, which is spearheading this. As I said, we have decentralized the pension function from Ministry of Public Service. So I request those former workers of East African Community, if you have not accessed your benefit, kindly contact the Ministry of East African Community Affairs. They will be able to assist you on how to verify and request for your benefits. Otherwise, I thank you very much, members, and time check is 11. And now I want to follow Asa in the last facilitator for today, as we agreed to stop at midday. Adam, are you there? Adam? We have a facilitator from Administrator General, and I wanted Adam to welcome our facilitator. Mr. Adam, are you there?
Yes, Chairman. Hello? Hello?
Okay.
Hello.
Yes, Adam. I'm now requesting you to introduce our last facilitator for today, from also the Facilitator General, and we welcome him to make presentation because we have up to midday to close this.
Oh, thank you, Mr. Chairman. Our next presentation is going to be on estates administration and will making. And this one is going to be handled by people who are trained in doing that without guessing. So this is Mr. Mungari, who is the Senior State Attorney in the Office of Administrator General. Mr. Facilitator, I take the pleasure and thank you for having accepted to spare your time and come and take us through estates administration and will making. Mr. Presenter, we are encountering challenges whereby most of the beneficiaries have failed to access the benefits of their deceased people because of, mostly, they have even failed because of failure to get letters of administration. More so, Mr. Presenter, there is a letter which originated from your office talking about the validity of letters of administration, and most of us have been confused. But I'm sure now, since you are with us, you are going to give us all the information that will now make us comfortable and guide us whenever we are handling such issues. I therefore take the pleasure to welcome you to talk to our participants. Thank you.
Members, a bit of patience. We are getting our facilitator on very shortly. I think there's a technical gap. We are trying to handle that.
Rwayende yempulira omuwala we. Henry, are you already online?
Yes, please.
Hey. Good morning, Henry.
Yes, good morning.
Yeah, so we are ready. I had already introduced you, so we are ready now to hear from you. Thank you.
Okay. Thank you very much for this. So you have already introduced me. Yes, I'm Henry Prover. I do work with the Administrator General's office, and I was requested to make a presentation on estate management and planning, and I have come up with a presentation that maybe will be shared with you to go through the details. So meaning my discussion is not going to basically read the presentation. I'm just going to highlight what I think are practical points, and then you can read in your free time. So the issue of estate planning is very crucial for everybody. It doesn't have a category of people that it targets, because it is dealing with a fact of life that we come into this life, we accumulate property and wealth, and eventually when God calls us, we have arranged our affairs in such a manner that doesn't leave chaos. I'm sure most of you see a lot of chaos in families after the death of the head of the house. So it is a very sensitive area. Parliament recently amended the Succession Act to bring it in conformity with reality. So that's why you have heard of expire of letters of administration, issues of residential holdings, and so on and so forth. So we are going to deal with estate planning, and the estate planning is in the different tools that I'm going to discuss this morning, the tools of estate planning. We shall begin with what is called the traditional mode of estate planning. and that is a will. A will is a very important document. Many people don't write wills, but quite a number also write wills. But those who write wills don't know the legal requirements of a valid will. So we usually start with the basics, that anyone above 18 years is free to make a will. A will is basically wishes that of a deceased person. So while you are still alive, you make your wishes regarding how your property that you have accumulated during your lifetime should be distributed, or how it should be managed. And if you are above 18 years and of sound mind, you are free to write a will. So I've listed a number of points there under writing a will. But we need to pay attention now to the amendment to the law, that there are certain things that you are not now allowed to do in a will, because a will is, you have freedom to do whatever you want in a will, but the law restricts you. For example, now the new law says you cannot, in your will, distribute your main home or residential home. Sorry. I think there was a technical problem. I'm sorry for that. So we were saying the will is written when somebody is still alive, but comes into effect only upon death of somebody. So meaning while you are still alive, it is a flexible document. You can change anything in it. You can tear it up and destroy it. You can do whatever you want. You can even sell the property that you have put in the will when you are still alive, because it has no effect when you are still alive. So it is also important to note that. So the will, places for keeping wills. So it is important that after you have written a will, that you keep it safely. The law provides for some places for keeping wills, but it doesn't prohibit you from keeping it in any other place. So you can keep it with a trusted friend. You can keep it with your banker. You can keep it with the Administrator General's office as safes where people can keep their wills. So it is an important aspect that you need to look at when you are making a will. The other aspect is on witnesses, because a valid will is supposed to be in writing and witnessed by at least 2 people, at least. So what it means is that if you write a will and it has 1 witness or it has no witness, it means it is an invalid will. So it is important that you have witnesses to the will. But as you get witnesses, avoid having beneficiaries under the will witnessing it. So, for example, if under the will I'm giving my son For example, a house, don't make the son as a witness to the will. Because what that means is that he will not get what you have given him in the will because he's a witness. So witnesses should not be interested parties. So that means the will not be invalid, but the gift you give will be invalid. In other words, the person you give, if he's a witness, he will not get what you have given him. So it is an important aspect that you look at when you are making a will. The other is that make sure you appoint executors to put into effect what you have willed or what you wish. Now, the reason why you need, remember we say the valid will, mainly two things. Signed by, it is in writing, signed by the maker and witnessed by at least two people. Now, those are the technical or what they call mandatory requirements, without which a will is invalid. Signed, witnessed by two. That's why you can make a will without even going to a lawyer, and it will be valid. But if you don't appoint executors, the people who are going to put into effect your will, then that means when you pass on, the family has to go through the office of the Administrator General, which is a long process to appoint people who are going to put the will into effect. So it is important that after talking about who you are, the children you have, the wife or wives, if you are polygamous, you name them. It is important to name these things in the will because after death, yes. So I've put there things that that you can look at, and then the Office of Administrator General, maybe I will work with the Adam. We have a template of a will, a very simple template that somebody can use if they want to write a will on their own. Adam, I just want to know that I'm being heard. There were a few internet connection issues, but I just wanted to know that I'm being heard.
Now you are being heard.
Okay, thank you. So
we can hear you. Kindly continue.
Yes, so
Yeah, we are following
the
you closely.
yes, so the will is the traditional tool of estate planning. It is still utilized, and we encourage. And like I said, we have some materials. We have a guide that we prepared together with the Uganda Law Reform Commission. We also have a guide to will writing, and I think at an opportune time we shall share with Adam. But that is about a will. So it is a traditional tool that can be used to arrange and plan your affairs in the event that you are no longer here. And that even includes the issues of pension, your public officers, issues of pension, people fight over your pension. When you are deceased, you can have a say on how that is going to happen in the event that you pass on. So, having talked about the will, and don't forget the debt, and also don't forget, if you are not married and you make a will and get married afterwards, the law says that that will becomes invalid automatically. So if you ever made a will when you are not married and then you eventually get married, you'll have to revise your will, because marriage changes many things. Because as you may be aware, a man has a responsibility to maintain his wife. So if you make a will when you are not married, it means there was no provision for your wife in that will. So the law will disregard that will. So upon marriage, people usually are advised to revise the will so that you provide for your people. And then also ensure that you provide for people who are dependent on you. For example, you are not under an obligation to provide for your 30-year-old child.
This guy is getting his things moving. He can't train through the things.
So it is something that you need to look at. People who are dependent on you. You must provide for them. For example, children below 18, your wife, dependent children. You must provide for those. So that means you must understand who is a spouse, for example. It is an important aspect. A spouse, that means somebody you are married to under Ugandan law. So I'm expounding. Some of the things I'm talking about are just an
We can't hear.
Recording in progress.
Sorry for that. Yes. Yes, I was getting an echo. Yes. So what a goodwill should have. We have put name of spouses, burial wishes. I'm getting an echo here.
We are no longer hearing.
Yes. Yes, so now I think you can get me. Yes, technical challenges. Yes, but so now we have looked at the main things to note before writing a will. What every will must have. I think we can go down. We have listed what a good will should have, name of spouses. I was just expounding that with spouses, a spouse under the law must be married to you under one of the recognized 5 marriages in Uganda. So that is either civil marriage, customary marriage, Islamic, Hindu, or church marriage. So those, if you don't fall into any of those, then you are in cohabitation, and with cohabitation you have no rights at all. Attempts to legalize cohabitation, as most of you know, attempts to legalize it have failed in Parliament. They don't want to recognize cohabitation, and many people actually are in the category of cohabitation, and we get a lot of problems during succession issues. Burial wishes, all this, all of you know what happens to even very senior and prominent citizens, where there is a dispute as to where somebody should be buried. Description of property, distribution of property, and so on and so forth. What can be disposed of in a will? It is only the property that you own. So you never give out property that is not yours in a will. Of course, if you do, it is null and void. Whatever you are giving out can't. Property that you are to receive in future, e.g. pension, employment benefits, and gratuity, all those can be disposed of. We said what you cannot dispose of. The law specifically says the main home or other homes can't be. They are supposed to be for the spouse and the children. And then we went through issues of the do's and don'ts in will writing. Do not give a share of your property to witness. We talked about it. If you give to a witness, the will is not invalidated, but the witness doesn't get what he or she was given. It's as serious as that. Do not distribute property without taking into account the interests of dependent relatives, like children and spouses. And then we are now looking at revocation, alteration, and destruction. Yes, we talked about destroying that. When you are alive, that is just a mere piece of paper. It has no effect. Takes effect upon death of the maker. So you can destroy it through burning it, tearing it apart, and so on and so forth. Then revocation by marriage. Then revocation by another will. For example, if you have a will of 2010 and you make another will of 2020 and they are in conflict, it is taken that the will of 2020 is the valid will. Revocation by codicil. Codicil is when you make a supplement. You can make a supplement to what you had already done, or make a supplement that is revoking what you had already done. And then, of course, there is one revocation and alteration by court. So we can now move down. I can see benefits. Those ones are many. The disputes that arise, costly litigation. At times, your estate is consumed by legal costs. So it has flexibility. We can move on. I can, yes, so then disadvantages. Now, when we talk of a will, we were talking about that branch of the law called intestate succession. That is where intestate succession is where you die when you have left a will, and intestate succession is where you die without leaving a will. And we are saying if you die without a will, then the disadvantages are lack of control over who takes out your estate, disputes. Intermediaries and lawyers will be your main beneficiaries. So your children may never benefit from your estate. Lawyers will become rich from your estate. Your cohabiting partner gets no share. Very important that if you are living with a wife, okay, not a wife, if you are living with a woman whom you have not legally married under the marriage types of marriages I talked about, the customary, the church, the civil marriage, the Islamic marriage, the Hindu marriage. If you have not gone through any of those forms of marriages, but you have been living with somebody for the last 30 years, you even have children. When you die, that woman has nothing to claim on your estate, and it is usually very painful. And people realize it when it is late. So it is important that you can even write a will where you are giving that cohabiting partner a share in your estate, because nothing stops you from doing that. You can go down. Now, after talking about the will, it is very important that we talk about alternatives to a will. And if, for example, you don't make a will, what are the alternatives to making a will? And this is where it is important. The issue of trusts, some of you may have heard of it, but the trust is an arrangement where the owner of property transfers it to another person who manages it for the benefit of other people. Now, that is a concept that is very prevalent in developed countries, and that's why their succession is smoother than ours in developing countries. When we hear that people kill each other over property when somebody dies, just know that we have not reached a level of being organized, and it is important that we begin. And some of these things are very simple, by the way. They sound big, but are very simple to create. So a trust implies 3 parties. Me, the owner of the property. For example, I own a building, a commercial building in Nyendo, Masaka. But I don't want that building to be sold or split up amongst my 10 children when I die, because that is what happens anyway. You leave 10 acres and then your children divide it into smaller plots. Some sell, some say, I don't want to sell, then confusion and arguments and develop. Now, a trust means that my building in Nyendo, for example, I create a trust. I go and register a trust. It is like a company, like you register a company, but this one you register at the Ministry of Lands. You register a trust where that property, that commercial property is subject to a trust. It is in my names, but I transfer it to a trustee who has, for example, expertise in managing property and collecting rent and so on and so forth. But the proceeds from the property are distributed amongst beneficiaries. That means I set out that these are the beneficiaries. The rent is 5 million or 2 million per month. When it comes out, distribute it to beneficiaries, each getting 500,000 or whatever amount that you agree on. Now, that means that even if I'm to die, my family will not labor with these things of letters of administration. Let's get lawyers, let's get this. They will just proceed. The trust will continue even when people in it die. In other words, for it doesn't die. It's a legal creation. So it is something that is worth thinking about, a trust, especially for people who have land and you don't want it to be fragmented. Like the president has always said, why do you divide land into small portions? That usually happens upon death of people. So a trust helps that way. Even when you die, there are no letters of administration because the trust continues to live. Your children will continue getting proceeds from the management, but they are not the ones in charge of the property because maybe they don't have the skills and so on. Now, gifts. Apart from trusts, you can make gifts of property. You give out what they call gifts inter vivos. That means you give out your property while you are still alive. It is a straightforward issue because it means if you give out all your property, then when you die, there is nothing to fight over. That is what it means. Then the third, we are now dealing with the other tools of estate planning. And all of them very practical and people do them, but at times not properly. Company shares. Company shares, again, just like a concept of trust. I have helped people, for example, form companies, Henry and Sons Limited, for example. And we all know the weaknesses of our children. You are like her. But if I leave this property with this son of mine, he will sell it and drink the proceeds. Or my children are not skilled in this particular area. What I can do, I create a company. And in that company, I make my children as shareholders. So I'm there with them. They are shareholders. And the company now owns my property. Very important. So if it is land, it is in the names of the company. So that even if anyone dies, business continues. Because the property belongs to the company. The company at law doesn't die when the owners die, for it continues. So you can use shares. And then when there are dividends, your children benefit from the dividends. They just share the dividends. They don't now tamper with the real property of the company. Next, co-ownership. Now, co-ownership is very important. And I'll use just an example of land ownership. It is very effective because it also avoids having to get letters of administration and so on and so forth. So co-ownership is divided into two types. we have joint tenancy, and we have common tenancy. Now, those terms, I can break them up just using some practical examples. If me as Henry, I have a plot of land titled, the title is in my names. I can decide that I register. If, for example, I have 3 children, 5 or even 10, I can decide that I register that title, not just in my names, but in my names and my 5 children, so that we all appear on the title as joint tenants. I am sure some of you might have come across land titles to that effect. Henry and then 5 others as joint tenants. They are owning a piece of land. Now that means that upon death, if Henry dies, the land automatically goes to the surviving 5 children. They become now the owners of that property. Automatically. No need for letters of administration, no need to go to court for probate and whatever it is. There is a smooth transition without hassles and hurdles of administration. So Henry dies, those who are surviving become now the owners of the entire property. So if there were 5 children, now the land belongs to 5, not 6, because one has died. When one of the 5 dies, the land belongs to the 4. One of the 3 dies, the land belongs to the 2, until the last to die is the one who owns the property, and so on and so forth. So you see that there is some form of organized succession that is not expensive. So that means the land belongs to the survivors. So it is there is that concept of survivorship, that the surviving become the owners of the land. So it is like you have done a will, but in a very cost-effective way, because you intended that the property should go to my children if I die. Joint tenants, or a husband and wife register themselves on the title as joint tenants, meaning if the wife dies first, the property still remains for the husband. If the husband dies first, the property belongs to the wife. So it is a very good tool that one can use, joint ownership of property. The second aspect of co-ownership is what they call common tenants. Now, common tenants is very important also, especially if you are, for example, not dealing with a family, and let's say Henry and Adam are business partners. They buy land and they put it in their 2 names. Now, me and Adam are not related, so I wouldn't want, if I die, the property to go to Adam. I would want my children to take my share. So common tenants comes in there. It is also a tool of estate planning, that 2 people who are not related, are just business partners, are registered on the title A and B as common tenants. Or we can buy 100 acres of land, farmland in Zimbabwe, and we say there are 100 acres, each of us has 50 acres on it. So we are on the title, but it is clearly demarcated that Henry has 50 acres, Adam has 50 acres. Total, it is 100 acres. We are on the title. So it means if Henry dies, the family of Henry is entitled to the 50 acres that he owned. I hope you are now getting the difference between the joint tenants and the common. So in the common, when one of them dies, the family of the one who has died takes his share. It doesn't, the whole of it doesn't go to the surviving, like in the joint tenants. That's why this one is used mainly for business partners. So Henry passes on, he has 50 acres, his family will claim the 50 acres. And then the surviving person, Adam, will take his 50 acres. So it is also a very important tool that one can use as a estate planning tool. So my presentation today was to just highlight the practical aspect, something that you can go and do even today or tomorrow. If you own property, instead of putting it in the will that I give so and so my land in Endeavor, I can decide that I register myself with that person on the title as joint tenants. When I die before him, he takes the property. When he dies before me, I take the property. So it is a win-win situation. Co-ownership of property, very important in this era. So I was saying in conclusion that estate planning tools may not eliminate family wrangles entirely, but they can contribute to family stability. Yes, family wrangles, even if you write a will, at times people can dispute it. So family wrangles will always be there, but estate planning tools try to reduce the effects. Reduce the effects. Even if somebody wanted to bring confusion, for example, on joint ownership, even if I am registered with one of my sons, the other sons, even if they are very jealous of it, the law protects the son I was registered with on the title by saying he automatically takes the property upon the death of one of the owners. So that helps to alleviate conflicts, especially in families. And of course, I talked about it just at the beginning about the amendment to the Succession Act. Issues of administrators who misappropriate estate property and then creation of offenses and so on and so forth. But I mainly dwelt on the estate planning tools, the will, which is the traditional, and then the non-traditional tools, that is trusts, companies, co-ownership, and gifts. I thank you for listening, and in case of any challenges we have had, I apologize. Technology is not as friendly sometimes. Thank you, Adam. And maybe I don't know that there are any questions.
Hello? Hello.
Yes, please.
Yeah, sorry, I've not lifted up my hand, but this is Fauza. And I have a question. Thank you so much for the presentation, Henry. I would like to inquire about the co-ownership. If I have land, and right now I have like maybe one child, but I hope to have others in the future, then I want to register this land on my title to have myself and the names, I mean all the biological children. But like currently I have one. How can I go about that? Can I put myself the name of that existing child and I say plus all other biological children, or I need some guidance there? Thank you.
Okay. I can see Mrs. Nambafu. Ekwaru Emma.
Yes, please. Good morning.
Morning.
My name is Ekwaru Emma from Napak District Local Government. I want to go to. Thank you so much, Mr. Henry, for the presentation and guidance. Straight to the issue of estate ownership. Here is a situation where I have written a will, maybe to my land, to be given to my first son, Peter. And then along the course of time, I realized I need to have some credit facility, and I mortgage it to the commercial bank. Unfortunately, I died, and then now I have not recovered the property from the bank. And of course, the bank has to continue demanding the credit in my absentia. Now, Peter probably does not even know about this outcome, and he's informed that his name, he has a right to this land, but the father mortgaged it. What will happen between now Peter and the bank? The bank will demand the money, but Peter will say, I didn't know this. So how can we help Peter? Okay. Then the other second question is, if it could be possible, the wills, they could be certified by maybe the office of, let me give an example, maybe state attorney. If they could be certified so that nobody, maybe after I die, should come and destroy this instrument, so that the beneficiaries are able to have it and have a right to my estate. Thank you.
Okay. I can see Juliana. I can see Juliana, and then I can see Akra. Whoever is ready can ask.
Okay, thank you very much. This is Akra. I would like to appreciate the Ministry of Public Service for putting together this, and then also I would like to thank the current presenter, my namesake, Henry. I see the time is not on our side, but I would have appreciated him to highlight on the recent policy on letter of administration vis-a-vis expiry of the letter of administration and the like. And then also whether the expiry issue, the expiry of a letter of administration issue applies to pensions, especially pensions which have been ongoing. Thank you so much.
Okay. I can see Nagudja.
Thank you so much, Henry, for the presentation. Is it possible to include our will so it becomes easier for us to
Could you speak up? I didn't get you properly.
Is it possible to have a template of a will so that we can, it's easier for us to write this?
Please speak louder. We are not getting you. Louder.
Close to his machine, our machine.
A template.
The template. Oh yes.
Of
the
writing
will?
a will.
Yes. Okay.
Henry.
Yes. Can I answer
Now
those?
can we go to Mugabe Arthur? Yes.
Mugabe Simon Arthur.
Yes.
The host keeps on muting.
Yes. If Mugabe is not ready, we can go to Mrs. Nambafu.
The host is unmuted. I don't know why.
Thank you, sir.
Who is this one? Nambafu?
The host is unmuting me.
Oh,
I'll
speak up.
Alan, stop embarrassing Mugabe Arthur. You are unmuting. Okay, let's hear from Nambafu as Alan is doing the needful.
Thank you for the present. This is Arthur.
Yes,
Now,
Arthur.
my question is, in Africa, it's very common to find a man having an officially married wife and then has children elsewhere. Now, we've seen cases where such men procure properties, like now maybe a piece of land, which they give as willing for their children before they die in the will. But at the end of, after a few years, these children, not born by the official mother, sell their properties given to them in the will and come back and encroach on this other house, which you refer to as the home. What's the legal stand on that?
Okay, Henry, your issue has been noted. You'll get a response. Mrs. Nambafu. Nambafu?
Yes, can you hear me now?
Yes, yes, we can.
Yes, all protocol observed, and thank you for the wonderful presentation. My concern is on, in case the estates, they come up with an account and then the IPPS that is linked for the officer, let me say he has passed on, gets blocked. What's the process of unblocking it such that the funds can be passed on to the estate? Then secondly, what happens in case that this is an officer and is it a process of divorcing the current wife who is official but has another one, but then passes on before it's completed? Thank you.
Thank you, Nambafu. Let's go to Samuel Nawita. Nawita, are you with us?
Yes, thank you so much, moderator and presenter Henry. I just want to inquire something briefly. What happens to a person who dies without any form of preparation for sharing his estate, and this person is a civil servant? Could you briefly take us through the process of acquiring or obtaining the letters of administration and how easy it is? Thank you.
Can I answer those? There are quite many. I think let me answer this. I'll start with her, and I was given up to midday, so I don't know whether I'll have
let's
enough
have the last
time.
two. Hello? Henry? Henry?
Yes.
Hello?
Yes, please.
I'm requesting that we hear from Naomo Juliana Korio and Wede Daniel Sami, then we shall receive your responses. Thank you.
Okay. Okay.
Juliana Akorio. Are you online? Juliana. Okay, Wede Daniel. Hello? Dirumuka?
Hello?
Henry. Dirumuka, Ronald? Yes, yes. Your question, please.
Thank you for the presentation.
You're
You
welcome.
said in co-ownership, when one dies, the property goes to the remaining. What about the children of the one who has passed on? Do they still benefit from the property? Thank you.
Henry, I think now you can respond.
Yes. Thank you. The first question was on I have one child now, and but I expect some in the future. Can I, on the title, put the one child I have now and the others I will get? It is not possible. It is not possible because with land is owned by living beings. So what you can do there is to write a will. But when you cannot register on a title some that is not existing, it has to be a human being or a company. Those are people who are registered on the title. So it will have to be their child. And if God helps and you get other children, you can always go to land office and the title is revised to include whoever you would get. Then dealing in property will, but the will is not revised. For example, like I said, the will only becomes effective upon death. Before that, it is a useless piece of paper. I'm saying useless in quotes because somebody cannot enforce it, because this participant said that he had willed the property to Peter in the will, but later on mortgaged it to the bank. Now, you are free actually to mortgage it, and you are free to even sell it. You don't even need Peter's permission.
Listening, but I'm left with few minutes to finish.
Yes. So if you give property in a will and then you mortgage it, first of all, you have the right to mortgage it because it is still your property. You are still alive, and it would mean that the one you had given to doesn't get it. Actually, your estate is supposed to continue paying the mortgage payments. The bank can actually go ahead and sell it if the family can't raise the mortgage. So in other words, it ceases to become the property of the person you gave the moment you make any decision that is contrary. Certification of wills to avoid tampering with them. Yes, that's why I talked of safe places for keeping wills, but also when it goes to court, people are free to bring evidence because of forgery. Somebody can bring evidence to show that there was tampering and so on. So the courts now, as we talk, are the ones which do the authentication of wills. Expire of letters of administration. Yes, letters of administration now expire after 2 years. And so when you get letter of administration, they're only valid for 2 years unless court extends them. But the law specifically said that when it comes to pension, the letters don't expire for purposes of pension. Because as you all know, a family can get pension for 10, 15 years, depending on how the public service calculates. So limiting it to 2 years wouldn't be practicable. So the law exempted estates that are receiving pension, their letters continue until the pension is exhausted. So I think that is okay. Will template, yes. The Administrator General will work with the Adam and see how to get copies of these. I encourage you to use that template. It saves a lot. Then there are people who get under the will, they sell, then they come back to disturb others. Of course, it is illegal. Once you get your share under a will, that is your share. If you sell it, you cannot come, and especially coming to the home. Like we said, the home is not subject to sharing, distributing it. The law says it should remain there for the surviving spouse. So if I die, my wife is supposed to continue staying in that home until her death. So you can't share it. Or maybe if she remarries, because when you remarry, you are supposed to leave the home. You can't remarry and remain in the home. Unblocking accounts of deceased persons, how do you do it? You have to get letters of administration. The reason why they block is at that time, there is no legal representative. So they are waiting for the family to get an administrator who will unlock and they access the funds on the account, bank account. Effect of, for example, somebody was divorcing, but they did not complete the divorce, and yet they have another woman on the side. You see, marriage is only ended by 2 things: divorce and death. Only 2 things end marriage. So if you were just in the process and you die, then it means you are still married at the time of your death. So your wife or husband gets a share as a wife, regardless of whether you had completed the divorce or not. So it is only when court makes the final order of divorce, that is when such a person is not entitled to share anything on the estate. What happens under intestacy? Intestacy, yes, and the procedure intestacy means that you die without leaving a valid will. What happens in brief is that you open a file with the Office of the Administrator General, you get a death certificate from NERA confirming death. You go to Administrator General, open a file. Family meetings are held where they agree on who is going to administer the estate. Once they have agreed and appointed the person or persons who are going to administer the estate, the Administrator General issues a certificate of no objection. Armed with the certificate of no objection, you go to court to apply for letters of administration. You advertise in the papers for 2 weeks. If no one comes up to challenge the application, then the court issues letters of administration. It is a long process, but I've summarized it for you. Where you start from is Administrator General's office. After that, you go to court. Now, the court is where, if you are from Soroti, it is Soroti High Court. If it is Gulu, Gulu High Court. Court of the area. And then joint and common tenants, just to clarify, joint tenants, it means that you are saying that when one of the owners or one of the people on the title dies, the property remains for those who are surviving. And I gave examples when it can be used. It can't be used in all cases. For example, this is mainly used for husband and wife. They register on the title. It means either whoever dies first, the property remains for the one who is surviving. I also gave the example of a father and his child, a mother and her child. Whoever dies first, because we all don't know when we shall die. So joint tenants it is a very dynamic tool. So whoever dies first takes. But you have seen that it is mainly used in family arrangements. Common tenancy is different. That is where the gentleman was saying, but what happens to the person who has died? The common tenancy is mainly used for business partners. I am owning land together with somebody who is not my family member. We are just friends. We are just business partners. So there I will be very careful. I don't want to use joint tenancy because when I die, he takes all the property. I will want to use common tenancy because under common tenancy, when one dies, the family of the one who has died takes their share. If it is 1 acre, they take 1 acre. If it is 10 acres, they take his 10 acres. And then the other surviving only takes his other share. And the title usually is very clear. It will say Henry and Adam owning this land in equal shares. The title usually has those words. Meaning, if it is saying in equal shares, it means that if it is 10 acres, it means both of us are owning 5. When I die, my family takes my 5. So it is, or at times they say Henry and Adam owning 60 and 40% respectively. So we know our shares. So your family takes just that share that you had it. So those two are very important, very practical tools that I would advise us to use. Adam, I think that is what I could do for the questions that were raised. There were about 10 that were raised.
Yeah, thank you, Henry, for the responses. Members, I'm sure you all agree with me that Henry has done justice. Hello?
Hello?
Yes.
Yeah, this is Were Daniel. I've been having problem with the
No,
internet.
Mr. Wele, you can send a message. We are through with raising questions. You send a message, then you will respond, right?
Okay.
Yeah. Yes, please do that. Members, I thank Henry for doing subject to this topic. As you all know, most of us fear to talk about the subject he has been handling. Will writing Most people take it to be an African. They fear that the day you make a will, then you are finished. But now with this information he has given us, I'm sure now all of us are going to guide our people, but we should start with ourselves by writing wills. And then we also guide them such that now we overcome this challenge. As you all know, we've been having challenges whereby beneficiaries have failed to access their benefits because of challenges in estates administration. So Henry, I thank you very much. You've done justice to the subject, and we pray that the next time we call upon you to talk to us, please do come again. So wish you a good day, and our regards to Mr. Victor Manzi, the Administrator General. Members, can you join me in clapping for Henry? A hand clap for Henry. Yeah. Yes. Now back to participants. Back to participants. Dear participants, I take the pleasure to congratulate you for having successfully completed these 2 days virtual training on pre-retirement. With sincere thank you for having attended in very big numbers. The number we've received is quite encouraging. Is far much higher than the trainings we've had. We thank you very much. And I appeal to you that when we get back, let us use the acquired knowledge and skills in guiding people to prepare for retirement. Then our brothers and sisters also,
not mine.
who are about, yes, hello. I'm saying our brothers and sisters who are about to exit service, I pray that you use the knowledge which you've received to make more adequate preparation for retirement, such that when you go in the new world, it becomes an enjoyable and comfortable one. Yes?
Also had my here.
I would like to confirm to you that all the presentations that were made are going to be shared with you. I therefore would like to request you, those who have not shared with us your email addresses, please do share. Then we shall share the documents such that when you go back, you're also able to share with other members who were unable to attend. With those few remarks, I take the pleasure again to thank you and congratulate you for having attended this training. I wish you the best day and my regards to all other members of the station and family members. Have a good day. Bye.
Bye. Thank you.
Thank you so much.
Thank you. Thank you so much.
Welcome.
Thank you. There were some questions on the chat they were not answered.
Yes.
There was questions on the chat. They were not. They were not answered.
Which one is that?
There are a number of questions that people.